All right, guys, today I'm talking to JJ, one of my favorite people. We're going through his $18,750 a month portfolio, or that's $225,000 a year he makes. His portfolio is worth $965,476 as of this morning. He has 29 holdings. JJ, thanks for being here. Let's talk about number one.
All right.
USCL, Global X Enhanced S&P 500. Why do you own it? That's 20.5% of your portfolio, 190 something thousand dollars.
Yes. So that position as of right now is my number one position. So think of it this way. I am not a pure cover call income investor, but I look at strategic positions. So I would say I'm kind of like a hybrid. It fluctuates in between growth and income. But this position specifically, so let's go through it right off the bat. So USCL, Global X Enhanced S&P 500 Cover Call ETF. Knew about it from Adriano, as we all know, who is the GOAT of the passive income investing style, other known as PII. So that one I've held since the beginning of 2023. Back then, XEQT, the iShares Global Diversified Income, the Global Diversified Fund, XEQT, which holds all of the top stocks around the world. That position was actually my number one holding back in, I would say, about 2023. That was about 90% of my entire position, because back then, once I first started, global diversification, top holdings around the world, no rebalancing required. It was very easy. It's the Canadian couch potato portfolio. You just buy it, set it and forget it, as is. But there was one main problem with that position, was the income generation, the monthly distribution. There was no monthly distributions. It was paid, I would say, about quarterly. So 4 distributions every year. And it was inconsistent. So sometimes it would be super high. At one point, it was paying about 3% of its stock price. And then other times during 2022, when there was a huge crash, that was about 1.5%. So that was like the minimum. So it fluctuated a lot. It paid every 3 months. And so it was really hard to maintain, like, to keep adding to it, just because you saw that portfolio. It was throughout 2022, 2021, 2022, it was so down. So at that point, when Global X released its income suite, there was USCL, QQCL, we'll go through all of that. But then the main Pacific position, as the USCL position, you're doing monthly covered calls on the S&P 500 index. Super simple. You're basically buying the index and you're writing cover calls on it. So it's basically a very diversified position in the income world. And so you can kind of see it as a VFE equivalent. You buy VFE for growth increase in the price, whereas USCL, you can also turn it into a growth position by just dripping or manually reinvesting all of its distributions every month back into the fund. So, and total return wise, it fluctuates. It's very in line because of that 25% leverage position. Without that 25% leverage position, no chance. Because of its capped upside. And plus, Global X usually writes its covered calls on it fluctuates between 40 to 50% of the entire position. So you're looking at about 40-50% cap ratio, and they usually write their calls anywhere between 1 to 5% out of the money. The closer to at the money position, the less upside you will gain during a bull run. So typically, covered calls, they perform much better either during a flat position, a slightly up position, or a slightly down position. A super bear position, it's not great for any position. There's capped upside, but then you get also all the downside. So in a complete bear run, growth and income they're all down basically. You might get
Yeah.
a little bit of recovery based on that monthly distribution that you do receive, but so your best bet is, so I would say with the leverage, with the out of the money cover call positions and up to 50% ratio, that other 50% is left naked. So it will do its thing. You get all the downside, you get all the upside. So I think it's a pretty balanced position. So based on that and the fact that, S&P 500, the top 500 companies in the US, which has already global businesses, like global exposure around the world already. So based on that, if you're a growth holder, you would hold VFE. If you're income focused, like me, at this current moment in my life, then I would say USCL, because it's also unhedged to the Canadian dollar. So it's a great, I'd say, unhedged position. So that's why at the moment, USCL is my number one holding at the moment.
I
Yes.
know this is an income holding, but do you treat it
Yes.
like a growth holding? Like, do you
Exactly.
like,
Yeah.
yeah.
So
This was,
based on the fact, sorry, just to cut you off right there.
yeah,
Based on the fact that it does pay monthly, so I get to choose whether I want to reinvest those proceedings back into this position specifically, or reallocate it into other holdings based on its portfolio allocation, whether or not it's higher than my average cost, and whether or not it's a safe position, like there's a good chance of rebound. So I like that choice. It's a bit more hands-on approach, but I feel like if you really want to become a more veteran investor, like you don't want to just sit back and let the fund managers do its thing. You won't do automatic drip. You would look at, once every time distributions come in, you will look at your whole portfolio, look at what's down, look at its allocation, how much you want to allocate, and just strategically reinvest it. And that's what I'm doing at the moment.
you do that for all of them, right? When all
Yeah,
your distributions
exactly.
come in.
Hmm.
That's smart. I'm happy you said that. So basically, no drip.
No
I
drip. Yeah,
don't do drip. Yeah, I don't do drip either. And then we basically, in simple terms, all right, what am I overexposed? Like, what has too much allocation in my portfolio
hmm
and doesn't need to grow? I wish I could build more. And then, oh, is the price at lower than my average share price? Oh, it
exactly.
is. Maybe I should buy in. That's just a simple way of saying that. There you go. And then, oh,
Exactly.
okay, I'll buy that. And then you buy more of that. That's actually the strategy that a lot of the guys, the bigger guys too in the space. I think Perry does the same thing.
Hmm.
Paul does it. I do that. That's why it's actually I'm slower going on acquiring positions now, because
hmm
now, like, we'll get to this, like, bank is performing really well,
Oh,
and
it's
I'm just like, oh
great.
yeah. But I'm just like, I don't want to buy it because it's performing well. I want to wait for something bad to happen so I can buy in. Like,
Hmm.
I'm waiting for the price because I want my average cost per share to go down.
Right.
Okay. So USCL, I'm going to
I
hold
just
on for a
wanted to add
second.
one other thing. So when it comes to like core positions, so there's a difference between core holdings of my portfolio and strategic undiversified positions of my portfolio. So when it comes to core positions, most of the time I don't really particularly care too much about the price, because I know
Yeah.
long term it's gonna keep going up. Like treating it as like a growth position, like just looking at VFE for example, today's
Yeah.
highs is tomorrow's lows. And that sort
Yeah.
of, if it's a core diversified position, that's like the underlying is super strong and super diversified and performs super well long term, then I don't particularly, like, I'll buy it. Like, to be honest, I like it when it's lower than my average cost. But if, let's say, for example, right now, the past month, super strong bull run, I don't like leaving stuff in cash for too long, because you never know. You never know if it's going to keep going, if it's going to recorrect, if it's going to correct a little bit, if it's going to drop. You don't know. You don't, like, nobody has a crystal ball, so it's really hard to predict exactly what the market is going to do. So what I do is, when it comes to core positions like USCL, if it's not too over my target allocation, that's about 20% give or take, then I don't
Yeah.
mind just buying in at that current price. But then when it comes to, more sector specific holdings like HHIS, like bank, like use, like go through all of it, then what I would do is, then I would try to buy in at a lower position, because it's a bit more, undiversified, so it might not
Yeah.
perform as well long term. We don't know. So yeah, one quick thing to add. Yeah.
That's a really good distinction. Okay. Yeah, because that's what we do for growth investing.
Hmm.
Anyways, it's what do we do? We're kind of more or less we're gonna keep saying VFE because that's the best
It's an easy
comparable.
one.
Yeah, but it's like VFE is the same thing. You're just kind of dollar cost averaging and you're trying to build that position. It's
Hmm.
today's high is tomorrow's low. That's exactly what's happening with USCL. So that's great. But then when you're like looking at MSTE or something, it's like, let's wait for
Exactly.
that
Yeah.
bad boy to drop to $9 again before I buy in. Like that's what I'm doing because it's going to bounce up to like 16 at some point, get down to 9, just capture
Hmm.
it at 9. Okay, so that's a really good distinction because everything here deserves a slightly altered strategy. So for this growth position, you have USCL. You're just kind of building it over time. This is I'm assuming, well, you take the dividends you take whatever the yield every month and you redistribute it into other positions you want to build or back
Hmm.
into this one if you feel like it's time for that one to grow a bit more. And that's what you're doing. That's what you're doing with this. But this is very much a growth position in an income orientated
Exactly. Yeah. And I
portfolio.
hold it
Okay.
mostly. It's the vast majority is in my TFSA. I have some of it in my FHSA. I also have some of it in my margin account. So not the
Yeah.
regular non-register and RSP. So it's those 3 accounts specifically.
Are your where do you live? Where are you from?
Montreal.
Oh yeah, I knew that
That's
actually.
me.
Man,
Yeah.
I keep are you you're fluent in French then probably, right?
Ouais, bien sûr.
Man,
Voilà.
you're the third French person or fourth French person I've had. I have a lot of French speaking people on this channel, man.
I would say
I
I am fluent in French, more English speaking because I grew up in English slash Chinese growing up like household, but I did
yeah.
take French immersion growing up. So I would say about 50 to 75% of all the classes I took throughout elementary and middle school was French focused. And then high school, when it comes to high school and the French immersion requirements, it changes. So it becomes more half and half, 50%, 50%, English and French. And then there's electives you can take. And then because of the fact that I had a pretty strong Parisian French background, so the more, more uh like nice French, there's different tones, different dialects.
You
There's
try
a
not to
Parisian.
offend anybody right now. You're just trying
Exactly. There's the
to
Parisian French, there's the Parisian French dialect, there's the Belgian French dialect, there's the Acadian French dialect, and then there's the Quebecois French dialect. So now, having lived in Montreal and being exposed to that Quebecois accents, so I would say over time it's definitely shifted. And one of the things I really like about keeping that French is because we are technically live in a bilingual country. So it's very important to have both languages, especially if you want to, be flexible and fluent in where you want to work.
Your ethnicity is Chinese.
Yes.
Then can you speak, is that Mandarin the main language or is
Mandarin,
that a
yeah.
different one?
Yeah.
Do you
So
have that in your back pocket as well?
yes,
Do
the
you
main dialect back home is Chinese. And I'm starting to learn a little bit of Cantonese as well, because um, I have a lot of like family members who also speak Cantonese. So I think it's important
yeah.
to learn that as well, even though it's kind of hard.
So Mandarin, Cantonese, French, and English.
Yes.
You're a cultured man. You're very
And I'm trying to
cultured.
learn Spanish.
Jesus, man. You're wow. Very, very cultured. Good for you. Look at you. All right. That's all languages you can speak. I can speak English and Punjabi.
That's very good.
Those are my big those are my two. All right, let's move on. Okay, so I think we got USCL pretty much figured out. I
Hmm.
think I think USCL is like a good one for people getting into covered call
For
ETFs.
sure.
I feel like,
Hmm.
right? It's like safe, long term. Oh yeah, another thing on that. Okay, because I hold it in my non-reg. My strategy sort of shifted to ones that I can just buy and never sell. It's
Hmm.
like like Perry and all those guys, they'll like sell weekly and switch up positions weekly and everything's a TFSA. It's all
Yeah.
that. I can't do that. And it's because I don't want to
Same.
like if I sell a non-reg and I sell at a profit, like I get taxed on all that. Like
Hmm.
a return of capital is actually not too bad of a thing. I mean, in non-reg,
It's
because it's
great.
taxed different. So for me, I'm just thinking, what can I buy that I don't have to sell that has high return of capital, right? And like I'm looking at other things in non-reg because just to help out. So I've actually changed my strategy. So I'm not looking for anything that I'm rotating through. Like if I buy it, I'm going, hey, this will be around for a long time, and I don't want to sell it because, you know, if I'm getting a return of capital and it's just decreasing, by the time I actually sell it and I sell it at a profit, it's gonna be a tax nightmare. So like I
Yep.
want to hold on to everything. So USCL I did have. I don't have it anymore, not for any negative reason. It's just I only have so much money. I want to allocate to some other stuff, but I love it. I
Non-covered call
think
stuff, right? Basically.
yeah, yeah, that non-covered call stuff, and I want to build up some of those Evolve ETF positions.
Oh,
So I was
they're
like, oh,
awesome.
okay, that's kind of all. That's all it was, but it actually will end up back in my portfolio. I'll just like right now, I kind of want to focus on a couple positions. Another one I really like. This is your second one is QQCL,
Hmm.
another Global X Enhanced Nasdaq 100 cover call. This is the yin and yang combination. This is what
Exactly.
talk a bit about it. This is
Yeah.
12.5% of your portfolio.
12.5% exactly. So I have this position both in my TFSA and my margin account. The vast majority is actually in my margin account, and we'll talk more about margin later on, I guess. But
Yeah.
I would say the current allocation division is about 20% in my TFSA and then 80% in my margin account. Why I like this holding specifically, once again, the underlying is the NASDAQ 100, which the breakdown is about 60% tech focused, 10% consumer discretionary, 10% consumer staples, and then there's like 20% in health and biotechnology stuff related. So it's definitely more tech focused. Whereas S&P 500, I would say it's a pretty equal allocation throughout the different sectors that are not. I would say it's a very good complementary to the TSX 660 of what we have in Canada. So it's a great complement. Whereas the NASDAQ 100 is definitely more tech and biotechnology and healthcare focused. So I would say if you're a very long-term growth investor or buy and holder, and like you don't want to like trim or make too many optimizations or allocations, then I would say NASDAQ 100 is a great complement to the S&P 500. I mean, you know, the equivalent is you buy VFE and QQC. Those two
That's it.
are, that's it. You know, it's very set in stone just because there's covered calls on it. If you look at the total return since inception between QQCL, because of that 25% leverage, leverage and covered calls kind of not exactly a one-to-one scale, but it does balance out the risk and capped upside. Where when
Yeah.
you have the covered calls, you have slightly less total returns long term, assuming we have a very long, very strong bull market. Whereas that leverage effect, although it goes both ways, it kind of balances itself out. So if you look at the total return since inception between QQCL and the Invesco QQC, which is basically the NASDAQ 100, uncapped, no leverage, anything, it's pretty much neck and neck. Actually, at this time, I just checked this morning, QQCL is slightly outperforming QQC slightly. But I mean, long term, you can kind of think of it as it's pretty much neck and neck in terms of total returns. So if you like monthly income, if you like having that hands-on approach where you decide whether you want to manually reinvest or strategic allocations, then I would say QCL is a great holding. And I'm actually going to talk about the fact that because of my long-term vision and the fact that I would be switching more into being more tech focused, I would actually be probably trimming down USC a little bit, adding more into QQCL and HHIS and those that are more tech focused and NASDAQ 100, just because if you look at the long term track record between the NASDAQ 100 and S&P, NASDAQ technically usually outperforms. Sure, there is higher volatility. Once during market corrections, tech usually always goes first, but it also
Yeah.
rebounds first. So assuming you don't sell, assuming you have a long-term vision, assuming you're emotionally stable enough to not make any irrational moves in the market, like you sell at a loss, you sell at the wrong time, you want to be buying and holding as is. And I feel like QQCL is a great position to do that because you get that monthly distributions. There's no need to sell. Like there's no need, if you're a buy and hold investor, there's no need to look at the market every week, every month. Heck, you can even like automatically drip it with your broker, assuming it allows it. But Wealthsimple and Questrade does for QQCL. You can just do that. Never, don't do anything rash. You can buy it, set it, forget it, check back in like 10 years, 20 years, and it's going to do its thing. Like, honestly, long term, it's a great position. So I'd say USCL, QQCL, they're pretty much, a great complement to any portfolio.
That's why I like these first initial ones we're going through right now.
Mm-hmm.
They appeal to the growth investor to me because
Oh, yeah.
all set it and forget it for the most part. It's like as long as the economy doesn't implode, like the world is still here, these will be just fine. Like the America has to blow up for these not to work, or
Exactly.
Canada has to disintegrate. So I like that. One thing I'm a little like, okay, so when I watch things on like Cover Call and things where people knock it, or when they promote it, people who knock it will go, and I'm gonna advocate for both sides here. So when Ben Felix does the video, he says cover calls are the devil or something.
Right.
He'll bring up cover calls that are kind of old. They're not like the modern strategies using leverage and stuff like that. It's like, oh, that's a bad example. He should have picked he should have picked like he should have picked actually like USCL or something.
The thing is, it's really hard to nitpick that because of how well it's performing. Like, regardless of the fact between either a growth investor or an income investor, total returns, which is price appreciation or depreciation and distributions you collect throughout a specific time period, is the number one factor you should be considering. Not yield, not tax. Like the tax, sure, like taxes are super important, but there's a great saying that Brandon says, is that you should not let the tax tail wag the dog, which means that you should not, just because you want to like optimize on taxes, does not mean you should be sacrificing returns on that. Yeah. Which means that you should not be buying like high Canadian dividend aristocrats, say, for example, in TFSA, because long term, the US market, if you look at the 20 or 30-year track record, US market, because of its innovation in healthcare, in biotechnology, in AI, in semiconductors, all of those will always be the front line of innovation, of change, which means that, technically speaking, assuming everything goes this scale and there's no huge market movement that causes some sort of like blow up, then typically speaking, US market long term will always outperform the Canadian market. Sure, in certain times, in certain time periods, Canadian market, because of its fact of its high cyclical nature, its heavy application in financials and energy and consumer staples that people are always need. It's less focused on innovation, but it's more focused. It's like the building blocks of any market. So it's more stable, it's more reliable, and so because of the fact that you can kind of think of it as it's not necessarily a fixed income category, but it's more fixed income like than innovation in the U.S. market. Does that make sense in a way?
Yeah.
Exactly. So because of that, U.S. market long term will always outperform the Canadian market. So that's why I have my TFSA structured more on innovation and less on the Canadian market. So there's that. Yeah.
How old are you? You're
23.
Young, right?
23. Yeah.
That's ridiculous. Look at this. Look at this rich ass 23-year-old. That should have been my opening. That's great for 23. Like I would not even know what to do with that kind of money at 23 years old. I would have messed it up bad.
I haven't really been looking at the large scale of what all of this means. Like you focus, like since 18, I've just been so focused on grinding, on hustling, on like building networks and connections and building a career and a little bit of entrepreneurship dabbling here and there. And it's looking at my, like, not just you, like looking at my portfolio and having even people like come up to me at the Blossom event. Sure, I'm not like that recognizable in terms of like fame when it compares to like Paul, like Perry, like even Jared, and like some of the other like Adriano, some of those in the bigger scale. Having people come up to me and saying that like you're an inspiration I follow you for a reason, like the way you are doing your trades. And because every time I make a trade on Blossom, my posts are usually a bit more lengthy in detail because I try to explain my reasoning behind why I make a certain trade, why I trim a position, why I buy a certain position. Not necessarily at that price point. Like, so most of the time because I don't like to, I'm not a day trader or swing trader or like someone that's super heavily focused in the markets. Like when I buy something, I'll look at the market usually at the beginning, at the open, and then maybe I'll look at it once during noon and maybe at once again at closing. So I do this like once a week every time I want to buy something. And then when I do that, I don't necessarily like to time specifically the price. So when I make a trade, I do it, I look at it, and that's it. And I explain my reasoning. And so most of the time, my posts compared to some of the others in the income space, like there are some people who would just, post that like, oh, I bought something today. No explanation, no reasoning. Most of the time, maybe it might be too yield focused. And that's one other thing. As once you become more seasoned and a bit more veteranized as an income focused investor, you'll tend to realize that yield is not the most important thing. Yield is not the most important thing. Total returns. The number one thing you should be looking at is not yield, because those will always change and fluctuate depending on the NAV price, depending on how well the underlying is performing. So the number one thing you should be looking and focusing at is what this ETF, closed-end health fund, mutual fund, whatever you want to buy, what it's holding its underlying, because that determines the long-term success or failure of what you're holding. Yield, the one big thing that growth investors would like to basically have a negative point on on income investors is the yield trap. And I get it. It's not a trap per se, but it is. Income investors like to focus too much on that while sacrificing total returns, which means that stock price appreciation is super heavily factored into. Let's say, for example, looking at the ultra yielders. So we have ULTY from Yieldmax. People got into it. Oh, I agree. Like, I am one of those that did get into it when it first launched at its stock price of about $20 USD. And I admit I was part of that group that what it was like 150% yield. It was crazy. It's clearly unsustainable just look at
It's a pretty good giveaway.
It's looking at that long term, there's no way it's gonna outperform the S&P 500 long term. There's just no way.
Yeah.
S&P 500, not factoring in inflation, you're looking at about anywhere between 12 to 15% year-on-year return, annualized, approximately. There is no way. Sure, in 1 year, something alternative like ULTY could outperform S&P 500 on a given year. If, for example, volatility is high, S&P 500 is not performing as well, there's some news, and then that could happen, but there's no way that will happen long term. And so that 150% yield that it was posted, there's no way it is sustainable. And just look at stock price. Since then, it's dropped by like 100%, which means that, guess what? Their NAV decline, NAV erosion, capital depreciation, whatever you want to call it, that is true. Because that yield is based on its NAV price, which means that as soon as the stock price declines, that yield will decline, and more, depending on the volatility underlying, it will decline in the same manner, which means that the number one thing that most investors should be focusing on, especially those who are newer in the cover call space and the other kind of ETFs that are being posted, the number one thing is total returns and the underlying. So that's what I wanted to say on that.
No, that was fantastic. Um, one other thing I want to kind of mention before moving on is you mentioned data and you're like, okay, well, USCL performs this way comparable to VFV. We track it, but like I come from an advertising background. We kind of talked about it off
Right.
camera. So I'm data heavy and I'm historical data heavy. QQCL is performing like neck and neck, but only problem I have is it looks great now. But
Right.
realistically, it would not meet my sniff test if I was doing data analytics. I go, it's not enough data to actually project out accurately
That's
what
very
long-term
valid. Yeah.
performance will be. So I end there. So like when I said one side was being critical, like Benfield was being critical of like not mentioning modern strategies, I also think that sometimes covered call investors get over optimistic on they know how it's going to perform in the long term, where I
Right.
think you should be a little bit more like, wait a second, I am a first mover here. I am the first generation of people testing out these strategies to this extent. And there is unexpecteds. I don't even know what the unexpected are. I'm not even saying negative. It could be a lot of positives for all I know. It's just, there is stuff that we just don't have data on that we don't know. And we're just going to have to adjust on the fly
That's
and
true.
figure it out. But I feel like if you're knowing this, going like, okay, I can't accurately project out. If I'm going to do it in the safest way possible, I'm using these first couple holdings we're going through. Okay, this is like the best way because these are the closest, because like this is the closest you're going to get to a stable, accurate strategy that you have more like. You can kind of reference VFE data. You can kind of reference QQC data and go like, because they're so comparable. I feel like this is
the underlying is the
why,
exact same.
I think that's why I feel good about these ones. I go, okay, at least I can. They're not so like, but then they're not so crazy like a ULTY or something. We're like, I don't even know. You're in la la land for that one. Like we have no way of predicting. But for these ones, core fundamentals. I feel like if you're a serious covered call investor, the ones we're kind of plugging through here are the ones that you should start with before branching out into other ones. It's like start here, build up these. Same way when I tell other investors who are growth, I go start with like VFV or VOO, those core index fund ETFs, and then get into more thematic ones, more nuanced ones, or then go into single stock picking. Like there's a step-by-step process. All right, let's go to number 3.
Oh, there's one other thing. One other thing I want to add on the diversified holdings, and that actually is on the line of taxes. So because cover call writing specifically in Canada, this is only for Canadian listed ETFs, not US listed ETFs. All of that, even though there's some portion of their cover call strategy, it can be classified as return capital, but then there's also qualified dividends, and then there's also short-term capital gains, long-term capital gains. All of that is taxed differently. But when it comes to us Canadian investors buying US listed funds, all of that is classified as foreign income, which is in the same tax structure as other income, interest income, whatever you want to call it, but they're all taxed the most at your marginal tax rate. So all of that, just keep in mind that if you want to buy US listed ETFs, you will have to pay more taxes and all of that as tax at your marginal tax rate in that year that you were filing your taxes. I mean,
if it's not held in your TFSA, right? If it's held in your TFSA and everything.
TFSA, it's all you have to worry about is that upfront 15% withholding tax. So
I'm thinking all those other guys are low, because like Perry and all those guys have a ton of US listed stuff,
which is completely fine. Yeah,
I think it's all in their tax sheltered accounts though.
But there's one other thing. This was actually brought up at the Blossom event. Someone was saying, one of the income investors, they were saying that, and I did want to fact check this. They were saying that there are other foreign taxes you have to be mindful of regardless of what account you're holding under, TFSA, RSP. Actually RSP I'm not too certain of. I'll have to double check on this. But TFSA, like all other non-registered accounts that are deemed non-registered by RS. So you have the Registered Disability Savings Plan, RDSP. You have the FHSA, the First Home Savings Account. You have the TFSA. You have any margin account or non-registered account. And all of that, if your entire position, like combined positions in all US listed securities or ETFs, so everything combined, exceeds $100,000. I have to double check this, but it's about the $100,000 threshold. You will have to pay foreign estate taxes. So you have to file separately with the IRS.
Across all accounts, they
Yes.
tally it?
I believe so. Yeah.
That
Because
seems like a low number.
I was filing my own taxes, and there is one line specifically. Do all of your foreign holdings, those include properties, securities, trusts, ETFs, everything, do all of your holdings in non-registered accounts by IRS, do they exceed that $100,000 threshold? If it does, then you have to file with the IRS, and there's more taxes you need to be wary of. So keep that in mind.
That's interesting. Does that I've been buying a lot of CDRs lately.
CDRs is fine.
Yeah, I know. But I've been doing that mainly because I'm lazy. I just don't feel like dealing with I don't know. I just been. But let's say I own,
because CDRs is Canadian listed, so you're buying
that's
on
what
the
I mean.
TSX.
Yeah, I meant that, but like I don't have to worry about that. I'm I'm kind of thinking out loud right now because I've been purchasing a lot of stuff, but it's all been like CDRs and stuff. But I didn't do it for the tax reason. I was doing it purely out of convenience.
Exactly, it's easier. You don't have to do Norbert's Gambit. You don't have to convert to deal with US dollars. So it's like.
But so many people hold. I know a lot of people who have hundreds of thousands of dollars in US listed Google. Does that make a difference if it's like if they just own Google shares, $400,000 US listed across all accounts? Then if they go to sell, are they being taxed now as foreign estate tax?
I believe so, yes.
That's crazy.
I'm really happy. I'm not a tax expert on
I would double check that only because I'm okay. Yeah. I'm okay because the last few years I just have been buying Canadian listed everything. So I'm actually okay with it, but I know a lot of people I've talked to and they haven't sold, but they have super lot. You're talking like in the millions.
Yeah, if you sell
US listed stuff.
Yeah, if you sell a lot in a specific year, and I think if that exceeds that $100,000 threshold, then there is other taxes you need to worry about.
That's just good to be aware of. Okay. That's thank you for saying that. You are the tax expert. You did tell me that. You're like, you know a lot about taxes.
I know a lot about the Canadian tax laws. Just for fun, because I need to. I mean, once you're buying all of this, you need to be wary of all the Canadian tax laws. Clearly, in order to
I shoot
pay less
emails
taxes.
to my shoot emails to my accountant all the time, like, hey, can you figure this out? So like, I'm really lazy with it. Like I send him all the stuff. I did a Canadian tax video, and the first thing I thought, like after I uploaded and I talked to you, I was like, God damn it, I should have consulted you before I upload that video. But it was okay. The video's fine. It's just some basic stuff. It's not the nuances like you just mentioned right now. Okay, let's go to number 3, bank, Evolve Canadian banks. So you have 11.6. This is the one that I wanted to get more of. This is my non-registered. Can you talk about how you're using it, and because you know all about this, is this beneficial for me to hold in my non-registered? And
I would say yes, based on the fact. So with bank, the underlyings are the top 6 banks of Canada plus the 4. So there's 3 life insurance companies. There's Manulife, Sun Life, and there's one other one, and then there's Power Corporation. So in terms of its underlying holdings from a non-tax perspective, it is great because, as we all know, financials in Canada is the #1 sector. So if you have financials, there's no rebalancing you need to do. You're not picking at any specific bank or life insurance company that you might have to still rebalance. You just buy one core ETF. You're good to go. It's diversified. You can set and forget it. It's completely fine. From a tax perspective, looking at their tax structure from last year, this is a bit of a ballpark because Canadian banks do pay eligible dividends. So you will have that eligible dividends portion inside your T5 slip. So it's either the T3 or T5, but it's basically breaking down all the classifications of the tax structures of what this bank ETF pays. So based on the fact that if you're doing a brief summary of all the eligible dividends, then they would all pay, you're looking at about 5 to 6%, because that's on average what banks, the Canadian banks pay, about 5 to 6% distribution dividend yield on an annualized basis. And bank, at its current stock price, you're paying about, it's giving out about 16 to 18% yield based on its stock price. So of that 18% yield, 5 to 6% is about eligible dividends, which means that breaking it down from a percentage perspective, you're looking at about 30 to 35% about eligible dividends. And then the rest of it is classified either as, so about 60 to 70% is either as capital gains or return on income. Rock. So that 30% eligible dividends. So depending on your province and your marginal tax rate in BC, I believe from taxtips.ca, which breaks down all the tax optimization of what's most tax efficient based on a non-registered account. I think it's up to about that $75,000 threshold where eligible dividends is pretty much neck and neck with capital gains. If you're under that $75,000 per year threshold, eligible dividends is more tax favorable. If you're under that $50,000 threshold, you will actually get a credit. So it's negative tax that you have to pay on eligible dividends between that $50,000 to that $70,000, $75,000 threshold. It's about 4 to 6%. And then if you cross it, capital gains / ROC, which is, you can treat it as delayed capital gains when you sell, that's more favorable. So depending on your marginal tax rate, and so it's kind of neck and neck between eligible dividends and capital gains / ROC.
Because it's $75,000 your income you bring in, if that's about it's
your combined income, everything total.
Yeah, I know. So it's pointless. It doesn't even make for me. I was like, oh yeah, maybe it's $75,000 and only the dividends I receive
everything.
Yeah, then I was like, okay, then it's all about. That's why I was like, it's all about return of capital. That's where, because you said over whatever, if you're over 6 figures, you're making that, you get into the highest tax bracket. It's
exactly, yeah.
ROC is more tax efficient, right?
Exactly. Because you're technically not paying any taxes, it decreases your adjusted cost base.
That's why I
like it. And then the thing is, if you're a buy and hold investor long term, because you're always going to be buying more shares, which means that price adjustment is always going to keep going up.
Yeah.
Right? Which means that technically there's no point that you're going to reach zero unless you don't buy at all. And then maybe in 10 years, once it hits that $0 adjusted cost base, then there's no more adjustment it can be made. That at that point, then you will have to pay those capital gains in that year. But if you keep buying, if you keep holding, then theoretically speaking, you will never reach that $0. So you won't be paying any taxes. So
let me just run this by you then. For me then, if I'm holding bank, I'm in the highest tax bracket.
So greater than $200,000 per year, assuming, let's just say example.
Yeah. And then so eligible dividends isn't a thing for me. I really, it's actually less beneficial that I'm getting dividends from the Canadian banks, essentially. Yeah. That's
because you will always be paying taxes on that eligible dividend portion.
That's what I was on. Yeah, that's kind of maybe I won't use bank then. I haven't bought it yet.
So at that point, if you're a high earner, then theoretically speaking, you should not be buying Canadian, the underlying should not be Canadian holdings that pay dividends. If you're buying Shopify or something tech related like Constellation Software, Shopify, or something else that doesn't pay any dividends, then you're fine. There's no eligible dividends portion. But as soon as there's an underlying holding that pays eligible dividends, then there will always be an eligible dividends portion of any ETF.
Yeah, that's what I thought. That's what I was thinking. I just wanted to run it by you then because I was like, shit.
If you're buying Shopify or something tech related like Constellation Software, Shopify, or something else that doesn't pay any dividends, then you're fine. There's no eligible dividends portion. But as soon as there's an underlying holding that pays eligible dividends, then there will always be an eligible dividends portion of any ETF.
Yeah, that's what I thought. That's what I was thinking. I just wanted to run it by you then because I was like, shit.
let's say it's still ballpark, because technically it's not a high dividend yield. Because they are dividend growers, so they're paying about 3 to 4% on average, and CDAY is paying on average, let's say about 16 to 18%. It's more or less in the same line of bank. So you can kind of, from a tax perspective, you're looking at about the same tax structure, 20 to 25%. Okay, it might be actually a bit lower, because technically it pays, because Canadian dividend growers technically on average would pay a lower dividend yield than Canadian banks, right? Because they are growing their dividends, so they would be paying less upfront. Whereas financials, they're not really growing their dividends. They're just pretty consistent, but they're not really growing their dividends. So from a tax perspective and a tax percentage, you're looking at about 15 to 20%. It's going to change every year. So every year they're gonna each fund provider will release the tax breakdown. It's like, say for example, when we're following our 2025 taxes next year, they will be releasing that information on their website anywhere between January to February. So there's going to be a breakdown of each percentage of what's being paid, either broken down as exactly as capital gains, ROC, eligible dividends, foreign income, other income. Other income and foreign income you can basically treat as the same thing as interest income. They're all taxed the most inefficient. So let's just say for example they're paying about 10 to 15% eligible dividends, which means that because of its underlying, there is no foreign holdings. We're still talking about CDAY, for example, specifically for this example, which means that of that 10 to 15%, that's eligible dividends, which means that the rest of it is going to be, it could be, the most tax efficient would be ROC in your specific scenario. So
that's what I figured.
That means that if it's a bull run period, then most of it is going to be capital gains, because there is no losses that the fund manager can take on the cover call writing portion. So there's no losses they can generate in that specific year. So in a bull run, most of it is going to be capital gains. There's going to be a very minimal percentage as ROC, because there's no losses technically they can take in that fiscal period. But if it's a flat or down market, then most of the cover call premiums that they generate would be eligible to be classified as ROC. So most of that 80 to 85% other category would be ROC, and very minimally or zero would be capital gains, but they would be flipped if it's a bull run. And it might be 50-50 depending on it, if it's like flat. Yeah. As an example.
All right.
Yeah. Hope that's pretty clear.
That's wicked. No, thank you so much for that. This conversation started, there's the GG Wealth Academy. You guys can join it in the link below.
I'm the Discord moderator, so there's always questions.
Yeah. So if you have questions, if you have tax stuff, don't ask me. Ask JJ. He's in there. And I basically, what happened was, I was like, hey, is CDAY any good? And I put it in the group, and you're like, no, not really for your scenario, because it's my non-registered higher income bracket. And
if you're in your TFSA and any other registered account, okay, doesn't matter. Like, they're all the same.
Yeah,
there's no tax.
But my TFSA, all tax shelters for growth stuff, I don't even do this in there. But that's what got the gears turning for me, being like, oh, wait a second, I got to rethink how I'm doing this. It's so like, and that's another thing is, you can't copy people's strategy one-on-one. Like, I have so many things specific to what I need in my for my portfolio setup, that my portfolio setup is for a guy who's not going to put it in tax sheltered, because it's completely, I'm maxed out everywhere else. And then I'm only doing non-registered high income earners, so I'm hitting a higher tax bracket. So then just like, you factor all this stuff in, and then I'm a growth investor by heart, so I want like stability still. And like, there's all these things that I need to, like, criteria that needs to be met in order for this to make sense. So I like bank.
What you can do, because I did notice when you were talking to all the other podcast guests, so what you would do, because everything is in your non-registered account, you would basically not reinvest any of the distributions that you collect in your non-registered account specifically. You will put it aside and just hold it as cash. That's what you're saying. That's what you've been doing, right? For
My
taxes?
my wife's my wife.
Okay.
So my wife is set up with HHIS in hers, and that's the next
Mhm.
one actually. So we can start talking about HHIS. But my wife is set up with HHIS. I sold my HHIS position in my account because I was like, I just want to have that capital for other positions. But
Right.
she's I don't know. She's like, this is off the top of my head, like $40,000 or something of HHIS is sitting there.
Okay.
That's just sitting there and collecting. We're not reinvesting, and I just figured I'd put it towards the taxes or whatever.
Is there a particular
yeah.
reason why you're not reinvesting those proceeds?
No, nothing really. It's just I haven't done tax season, and I just because tax season is a mess. Because like I said, I run a business. I have
Mhm.
and I have so many income streams that I just learned the hard way. Just like I rather just have too much money laying around than not enough.
What
So
you
I just like have it.
can,
Yeah,
yeah. So what you can
yeah.
do for that portion that you're setting aside for taxes, instead of leaving it as cash because it's not doing anything,
I have it
you're
in a
actually
cash
losing.
ETF. I have it in an
Oh, okay.
ETF. Cash. Yeah.
Right.
Like that's I call them the same thing at this point now because they're so easily like a cash ETF I can sell right now and get the
Mhm.
cash back. Like so for me it's fluid enough, right? So
But
yeah.
so do you and your wife file your taxes like together, or is it separate?
For personal income households, you have to do because they do the household, and then we do corporate taxes as well for the company. So
Okay.
there's like they're split up separately, but then we're also employees of our company as well, right?
Okay.
So we do get so yeah, that's the structure.
So because everything technically we're supposed to be focusing on your wife's portion, is
Yeah,
she in a high tax bracket?
yeah, she would. We're all in a high tax bracket,
Oh, okay.
so
That means that actually,
no one gets alleviated here. Yeah,
right,
yeah.
that means that that cash allocation, because it's paying for, actually it's pretty low. It's like 3% now because Bank of Canada actually just cut its rate again by like 25 basis points, which is great for margin if you're borrowing, but it's not great if you're putting it in a savings or GIC because everything goes down by 25 basis points, which means that let's just say, for example, right now it's paying on average like 3% now on yield. I haven't looked at cash's yield in a while, but I know it's about 3%. Like it's pretty much neck and neck with the overnight rate, which is at 2.7%. So 2.75%, 2.75% right now by Bank of Canada, which means that cash is paying about the same minus a little bit. So you might actually be at 2.75%. That 2.75% that you are getting is all interest income, which means
Oh,
it's not very tax efficient anyways. It's not very, like, it doesn't really matter if you're in a lower tax bracket or if you're in a low tax bracket and there's not that many taxes you have to pay. But because of your specific scenario, you're in a very high tax bracket and cash pays interest income, you might want to look at cash generation that pays eligible dividends or ROC or capital gains. I know you did want to
that's
talk about SPLT. So
that's the one I was going to say. That's one you recommended me. So let me give
Mhm.
you more information behind this. So for my wife's cash, she's like on HHS, whatever that monthly dividend is. It's not
Mhm.
a whole lot. I think it's like $500 a month or something.
Okay.
I'm like, okay, I don't really care if we get hammered there by whatever. But I have a ton in cash ETFs, but I just needed it really liquid because I'm in the middle of buying stocks right now.
Mhm.
So like I just need to transfer it quickly. So like I actually don't even care too much about like what I get paid out for that
Okay.
percentage. I just wanted anything that's better than just pure cash. I need to set the closest thing to pure cash that I could immediately flip to like, all right, I need 50 grand right now really quickly. I
Okay.
got to buy something. That's it. So like
For
it was
liquidity,
nothing.
cash is great. There's no problems.
Yeah, and so I have a couple 100K just sitting around just in like that, but only because I just need it purely to like I need it right now. So the reason why when you mentioned SPLT, I was like, oh, that looks good if I was gonna hold it for like months on end or more and then actually do something with it. But I was like, I'm flipping this cash really fast right now. I just didn't this I just didn't want it in pure this actual cash. I'm like, anything's better than this. I'm like, I'll just put it in
True.
a cash
That's fair.
ETF. That's sort of all it was, but I wasn't looking at it as like any sort of even income generation or anything like that.
What for that cash ETF allocation of your entire portfolio, is it a large percentage or is it a large percentage?
No, so I have for covered call ETFs, I think I got like $100-something thousand. I can allocate for that,
Mhm.
just in cash, and that's what I gave on Blossom. But then I got hundreds of thousands of dollars for actual single stocks in cash. That's off. camera that I don't show anybody.
Mm-hmm.
But that's the turnaround on that. It's really fast though. That's the big
Okay.
thing. Like it'll be all allocated. Shortest 6 months from now. If it just takes me a long time to figure out, it could be 12 months, but it's dwindling every month. It's getting smaller every month,
Okay.
is what I'm saying. So it's not there.
No,
To sit
what I was
there.
asking, like, for that cash ETF allocation though, is it like 10%, 20%, like lower?
Less than 10, less than 10% of my portfolio.
Okay, if it's in less than 10% per portfolio, then I guess you're not paying that much more difference. So there's not that much optimization you need to do. But let's say, for example, you are opportunist investor, and you're like 50% of your entire portfolio is sitting in cash or like a cash ETF, then you could be paying a lot more in taxes. So then you might want to optimize and put it in something else that doesn't really pay interest income. So you could be looking at HSAVE, which actually doesn't pay any dividends or distributions at all. It just grows in price and capital appreciation, and then you can sell it, and that would just be triggered as a capital gain. And then, but you can also look at SBLT or PREF from Quadrivest. It's the same thing, all in one preferred shares. Preferred shares barely move in stock price anyways. So if you hold it for at least like a couple months, then there's no big swings in price. It might act like cash. You know how it fluctuates from $50 to like $50 and like 16 cents, and then drops down to $50 every month because of that ex-dividend day. So you get that 16 cents difference in distribution in interest income. Where it comes to SBLT and PREF, it behaves the same way. Because it's an all-in-one basket of all the preferred shares by Brompton and Quadrivest. Preferred shares in Canada don't move in price because it's not Class A, so that you can kind of think of it as an alternative to cash. If you're at least holding it for a couple of months, there is very minimal to no change in stock price, but that distribution that they are paying, because it's on preferred shares and it's on stocks, it's then tax classified as 20 to 30% as eligible dividends, and the rest of it as capital gains / ROC. So it's technically more tax favorable.
Okay, so that's good to know. My biggest thing
if you don't care, if it's not a big allocation, then it's very minimal
because I
difference.
always have like 10% just hanging around sometimes when I'm like just to buy, because I'm always at every point in the year, because I have so many individual stocks, I'm rotating through stuff. Like things are meeting their sell price, so I'm selling something, then I'm buying something. So that allocation of 10% is always growing. My portfolio is always growing. So I always have like 10% floating in cash for buying opportunities. It is good to know though, because honestly, when you said SPLT, the only thing I was worried about there originally was like, oh, because the stock price does move, and I was like,
it does move a little bit, yes.
I'm like, I just don't want any movement, because like this is trying to be as close to cash as humanly possible without actually being cash. That was the only reason why I didn't do it. And I was like, oh, this still is like a lot of money, so I was like, and I didn't do it, but it's something maybe I should consider it.
Yeah,
if it is more tax efficient at least. Okay, so that's bank. It works well. Maybe not as optimal for my position as I'd like, but still not horrible though. It's still a great fund.
It's not paying a very high yield. It's literally at 2.75% right now. I just took a look at cash's yield. So
what's the percentage?
2.75%.
Okay. Oh yeah, whatever. Yeah, so
it's the same as the overnight rate.
I just need cash. It's just pretty rather than just hoping actual straight. I used to do that, by the way. I used to just hold just cash, because inflation. I don't get as worried about inflation, because it's like it's the money's moving constantly. So it's like I'm not doing what people do. Like they just sit on a stockpile for 30 years and just like let it deteriorate. It's like it's always doing something. If it's not doing something, it's about to get used for something. And then I obviously have a business where more money's always just funneling in. So like I kind of just, it's not something I worry about as much on my end. Okay, so number 4, HHIS. Okay, this is what we're talking about. Right. Man, this got really popular really fast.
It blew up.
What do you think it was behind that? Do you think it was because they're aligned with Blossom, like they're one of the top sponsors? So everyone on Blossom just started talking about it. They just started selling like hotcakes. It's one of the most top traded ETFs on Blossom as well.
Mhm.
Obviously, it performs really, really well. I personally think I like HHIS, but I was like, it kind of
Mhm.
looks overvalued. It's overvalued, I feel like. I'm like, what? Because it's like capital appreciation on a covered call ETF
That's
of
very rare,
a,
right?
a
Especially at, like,
12%.
so much, yeah.
I'm at like 12% or something crazy from my capital appreciation on a covered call. I was like, this
What's
is
your average
all very,
cost?
I don't know. Let me check. I can check on my phone. Just keep talking, but I'll check on my phone right now.
Mhm.
But it wasn't a whole lot though.
So I would say in terms of HHIS, because Harvest is usually out of all of the Canadian fund managers, I would say Harvest is like Evolve. Like I would say Harvest a bit more is more focused on price appreciation rather than too much in income. So they really found that balance. So all of the large fund managers in Canada, we're talking specifically Hamilton, Harvest. I'm not too familiar with CI. So we have Hamilton, Harvest, Evolve, Global X. So the top four. Global X is kind of sitting in the middle, but Global X is a bit more focused on income. You'll notice that their usual allocation is 50-50. So 50% cap, 50% cap ratio, 50% uncapped, and their call writing is usually a bit more aggressive. So usually fluctuate between a 1-2% out of the money, it might be less, depending on the market. Well, depending on how the market is at the current moment. And then Evolve, and then you have Evolve, which is shifting more towards the price appreciation, but still high income. And then you have Harvest, which is even more. You'll notice that most of the time Harvest sits between, they can technically on their prospectus, they did say that they can write up to 50% of the entire coverage. But you should like to do is sit between that 30 to 35%, which of it's being capped. But the trade-off is you have more of the underlying that it's uncapped. So like you see currently in the bull
Yeah.
run, everything, most of it is uncapped, which means you see most of it as capital appreciation. And because of the fact that when you look at HHIS, it's 15 holdings of the NASDAQ 100. Well, -1. So because ELI literally is secondly on S&P 500, but 14 holdings is part of the NASDAQ 100. So you can kind of see of it as a concentrated version of the NASDAQ 100. NASDAQ 100 is like a concentrated version of S&P 500, and then HHIS is even more concentrated because it only has 14 holdings of the NASDAQ 100. And so you have that more capital appreciation focus, plus the fact that it's more concentrated during a strong bull run like we've seen in the past 1-2 months when you have concentration, because concentration, you get more, you're more exposed to the top holdings which are performing better and less holdings that are not performing as well. Like this is the trade-off of an index. Like because when you look at an index and it's market weighted, when you have the top performers that are performing well, you have a bunch of other holdings in that position that are not doing as well. You're kind of dragged down overall in terms of performance, right? When you like the more holdings you have in an index, the more of that drag down behavior you would see. But then the trade-off is if it's in a period of high volatility and then not doing as well, then if you have a small percentage or an average percentage of holdings that are not doing as well, it will be propped up by other holdings that are more defensive. So you're kind of taking like the average. So you get less concentration on the upside, but you also get less
Yeah.
concentration on the downside. So it's more line in line. So when you have that concentration factor, it goes both ways. So you will see if the bull run switches to a bear run, those underlyings, because most of it is tech focused, tech and innovation focused, because you have strategy, you have Coinbase, you have Palantir, you have NVIDIA, you have Tesla, you have Microsoft, most of those are more innovation focused, but then you have a bit more defensive, like Apple, like Google, like Costco, like Netflix. Netflix, you can kind of see this at the in between, and then you have Eli Lilly in there. So it's more concentrated on the upside, but you can also see it as more concentrated on the downside. So it flips, then that price appreciation might go away. So you would probably see more of a depreciation in the stock price, but also that is going to be balanced out by more volatility and more income from the premium perspective. So it goes both ways. So that's why you see, because of the bull run, you see it technically performing better than the NASDAQ 100 on a total return perspective. But if it flips, it might perform a bit worse than NASDAQ 100 on the downside. So that's probably why, because it's most of the underlyings in there are like they're doing very well. So it goes hand in hand basically. So I'd say that's probably why it's blowing up as one of the top performers.
I want to take this second for the audience to appreciate how smart you are.
Oh, thank you.
Just listening to you talk, being like, shit, bro. Yeah, really, you know your shit. It is crazy for a 23-year-old.
Most of it, you can kind of think of it as
common
common sense, right? Yeah.
No, but you're good at articulating it. You're saying, like, it's great. I love the points you're bringing up, man. Honestly, you're bringing up all these things. I'm like, God damn it, that's right. You should mention that. You should mention that. That's fantastic. So I appreciate the knowledge you're dropping right now. That's all I want to say. And you wanted my share price. It's $11.92.
Yeah, you got a good price. You haven't bought it recently, right?
I didn't buy it recently. I bought it a while back. So I sold all my stuff. So this is just what my wife's bought. I bought in her account first, and then I bought it in my account after. And when I bought it like $12, so it was still pretty cheap. So that must have been a few months ago. I'm probably made a video about it. It was when I made a video. I was like, hey, I'm buying HHIS.
Oh, that's right. So that's about a month and a half ago, probably?
Maybe, I don't know, man. Time's blending together, but it might have been like a month ago. Maybe probably more than that. I did it over summer. That's all I know. And I haven't really added to it since. So, and it's just been going like that. I've been watching it go like that.
It's like a rocket ship. I'm just like, do I want to buy more? I don't know.
Yeah, I hate buying things while they're doing well. That's just because that's a value investor for me. Like I do not. It's a hard habit to break. Like things I buy when they're doing well is like VFV. And so like when we started this off, I was like, okay, that's a great way to keep me buying USCL and stuff is keep remembering VFV. One thing, I was talking to someone who's not big on covered calls, and then I was telling him like, here's how I frame covered calls in my mind as a growth investor, how I see it now. And HHIS, I think, is the best example of this. And maybe this is why I like it a lot. I have growth investments, I have value investments. Psychologically, they do something, but for covered calls, that's a strategy. Right? You're writing covered calls. That's like an actual strategy. Yeah. So I see, and I own a business. I see Harvest as an employee of mine. Yes. That's what I see. I go, hey, Harvest, their management fee is a fee I pay them. I'm like, great, guys. Here's the thing. Here's our contract. I'm going to pay you X percentage to manage this. For me, to manage my $40,000. I own 15 different stocks. I have Tesla, I have Microsoft, whatever they hold. Here are the 15 I hold. We call it HHIS. I want you to write covered calls on like 30 to 35% of this, right? Because I want that covered call. And I want the rest to just get that capital appreciation. Okay, that's the strategy. You guys cool? Great. There's your 20, whatever your cut is. That's how I see it.
Yeah, exactly.
So that's what it is.
That management fee that you are paying, it's kind of like a commission that you're charging for the convenience. So the way I like to frame covered calls or any other income generation is like buying a real estate property. Keep in mind that example. So you're paying an upfront fee for that management because you're paying for the expertise. Because let's say, for example, you have each individual share that you are buying for, regardless what income ETF that you are buying, it's one kind of like one person that you are managing, that they are managing that property. This is going to be like a ridiculous example, but it's like one employee or one worker that's working on your behalf. Yeah. And they are doing that generation regardless if it's like, oh, they're collecting rent or they're doing something regardless that they're earning some kind of income producing that you don't have to do yourself. Because sure, you can buy that growth fund and you can pick those individual stocks, or you can pick that entire basket, but everything is passive, which means that it's gonna fall in line with that market. So if you buy that growth fund, you can't do really anything with it. It's like buying a property that you're doing none of the work. You're just sitting back and you're going to do something else. You can't manage it. You can't do anything yourself. That's going to either increase in value, decrease in value. It just as it is because it's going by the market price. You see what I'm getting? So with everything is super passive. Whereas when it comes to covered calls, sure, you can do it. You can clearly do all the call writing yourself because most brokerages, they do charge a commission fee because it's more hands-on. There's more risk involved. You can do all the puts. You can do cash secured puts. You can do naked puts. You can do cash secured calls. You can do naked calls. All of that all of those hands-on work yourself. It's like when you're buying a property and you're doing all the maintenance yourself, you're finding tenants yourself, you're doing all the repairs yourself, you're not outsourcing any of the work. But when you have these fund managers acting on your behalf, it's like you are basically paying a management company to find tenants on your behalf, assuming they're doing well, to do some of the maintenance on their behalf. They're finding all the workers that need. They might do plumbers. They might have roofers. They might have renovators, construction builders. They're doing every work that's trying to bring you more rental income every month, regardless of the market value at that time. Because the long-term perspective is, think of it as buying a rental property. You don't necessarily care about what that property's market value is at that price point, right? The main point of buying a rental property is getting that rental income. So what's important is finding the right tenants, finding a great location, doing the maintenance properly, making sure that everything you are doing, it can guarantee you more rental income every month. So that's kind of like the inline perspective of buying cover call ETF. And sure, there are moments in time where that distribution could fluctuate. It can go up, which means that you can think of it as, oh, you're getting a bonus that the tenants are paying you for, doing a great job, or you're getting kind of some kind of credit from the government for just doing well. That property is doing well. But then you can also have periods of moments where those distributions can get cut, which you can kind of see it as, oh, like there's some kind of a situation going on in that particular location of that property. So it's not doing as well. The tenants could be in some kind of trouble, but to avoid any legal issue, you could eat a slight loss. But there's no overall impact on their market value. That's not what you care about. And so maybe not the best example, but hopefully that was pretty
works.
clear.
And when you reinvest, are you just buying more rental units?
Exactly.
You're
You're scaling up in that property, like you're doing some massive renovation project, or you're buying a property somewhere else.
Yes, that's it. Yeah, you're either renovating the current property or you're buying another property somewhere else,
Exactly.
which is a different ETF or something.
So it's a really good thing because you don't want to have too much concentration risk in one fund manager, in one sector allocation, in one stock or bond allocation, in one fund manager, and one strategy. So a really key point. That's what Perry and Paul were saying, that it's very diversification in sectors, diversification in fund managers, diversification in strategies. You can kind of think of it as diversification in rental units and properties. So you buy different kinds of office buildings, vacation rentals, office rentals, residential rentals, townhouse rentals, whatever you want to think of it as. All of that diversification, sure, you could get lower total returns depending if one specific property does super well, because it's going to affect your portfolio less in the long run. But in a down cycle, which can easily happen because, like you said, there is no strong long-term track record in a super long bear run of what it could happen. Sure, the underlyings, they're the same. They're great positions. But in order to have that safety, it's very important to have fund manager diversification. Just like in any portfolio, you wouldn't just be concentrated in one sector. So that's very important to think about.
Do you only work with the covered call strategy though in general, like the covered call ETF strategy in general? Because like I have three distinct strategies, right? Like I have
Mm-hmm.
three. My split would be 70% value. I have the Gill family portfolio. It's a fund
Mm-hmm.
managed by me. My stock, it's like my S&P 500 that I've created for myself. That's the top performing part of my portfolio. And then I have the 25% that's managed by Vanguard and other BlackRock, which is their index funds. They do the management.
Okay.
I pay them a fee.
Mm-hmm.
That's just index fund. That's like VFB and stuff. And then I have like 5% or so now in like covered calls, and that's managed by
Evolve,
Evolve,
Harvest, Hamilton, all of the
Harvest, all
sorts.
those
Yeah.
guys. But it's really is how I manage my me
Mm-hmm.
wanting to write covered calls. They do that for me. Me just wanting some generic index funds with slight rebalancing. I pay a small little fee to have Vanguard do that for me.
Mm-hmm.
But then the real gains, the real money is made by my family run fund that we have. That we have our own individual stocks that are rotating out, yearly. Some of
Mm-hmm.
them are long-term holds, 10, 20 years. Some of them are
Right.
5-year olds. Some of them are 12-month-old. It's varied. And there's strategies within that.
Mm-hmm.
1, 2, 3, they're all separate. When one can fall, the other two will be fine. Unless the whole stock market falls, they're all good.
I
And
think
even within,
at that point, there's probably bigger issues than just the stock
yeah.
market. The whole world goes to crap.
We're screwed. Like money doesn't matter anymore at that
Yeah.
point, right? Yeah. So is this your primary strategy? Like when I
Mm-hmm.
talked to, who
Exactly.
did I
Yeah.
talk to? Perry said he's like a little bit of growth mixed in there, but you're completely this. You've just kind of built in micro strategies within this to add
Exactly. Yeah.
diversification.
Because
USCL growth,
mm-hmm.
right? Like, yeah.
Yeah,
Go ahead.
exactly. Because right now it's just me. Like I don't have any other dependents, unlike you who has a whole family. Then there's
Yeah.
different fail states you probably want to put in place in
That's
case
what
anything happens. But
yeah.
because of the fact that it's just me and I know what my risk tolerance is at that specific point in my life, most of it fits well with the income balance / growth preservation mode at this particular time point. Then yes, I would say about 90% of it is in these cover call strategy. Sure, like all the holdings you'll look at, they're all different strategies, they're all different focuses. But at this particular moment, then yes, majority of it is cover calls. That's not to say that if I start a family, if there's other dependents involved, then it would be more diversified in terms of strategy. And just because doing these cover calls, there's a lot of management needs to be. It's not exactly a set it forget it strategy like Adriano has. Like he has like what 7 holdings, so it's pretty much you can set it and forget it easily. But I've built it to the point where like it's a bit more hands on, which I do like at this particular moment. I like to know how to strategically rebalance specific holdings, but later on in life, because I'm still in my 20s, so there's probably a lot more time involved. But once I reach 30s, 40s, everybody's risk tolerance and risk preference shifts when there's more dependence involved, when there's more issues in life in general gets involved, then there would probably be a more shift in tone and strategy involved. But as at this moment in this particular snapshot in my life, then yes, it's about 90% cover calls at this given moment.
Because you're 23 and your portfolio is very large for a 23-year-old, and it's an income-based portfolio, do you ever just think, I'll set 50% of this to a drip, and then I'll go travel for 7 years?
Everything is technically on drip right now. I'm not using any of the money.
Yeah, but like, would you ever just be like, I'm just gonna go travel for 7 years and just go use 50% of this and then check back? Because even if you set 50% at a drip, walked away, came back at 30 years old, you'd have a massively larger portfolio,
right?
In 7 years, and you'd be living off it. So you could just screw off and do nothing for 7 years, essentially.
I could.
Yeah. Obviously, you're driven. You're not gonna. Has that ever popped in your head? Be like, because I talk to people all the time. They're like, "Hey, I travel in Thailand. I'm over here. They're just floating around all day." Or you
based on the way I am built, it's really hard for me to like, it's that whole mindset shift of not doing anything productive. That's kind of
Yeah.
scary. I don't know if you've noticed, but like, especially in the traditional Asian family, there's always competition, very toxic competition
Uh-huh.
between different family members. Oh, like, oh, your cousin is like studying at Harvard. Oh,
Oh yeah, yeah, yeah.
he's a financial analyst. Oh, he's a top mathematician. He's a doctor. He's a surgeon or whatever. So all that competition always gets baked in, regardless or not that you were brought up with it, but it's just kind of like baked into the culture. So it's very, I guess it's a huge mindset shift if I were to do this. Sure, mathematically speaking, I feel like it would be completely fine. But just from a psychological perspective, based on the way my mind is driven, because even now, I'm not using any of the money. Like everything is in the accounts. They're all reinvested. So 100%, maybe I'll take like 5% just to like go eat out or something. Like I might
Oh
not
yeah, yeah.
reinvest like 5% of the money in my non-registered margin account, which I can easily take out. Everything in my TFSA, in my RSP, in my IFHSAs, they're all reinvested. I'm not taking any of that out. So
Definitely.
it's all taken first from that margin and non-registered account because you don't have to track contributions, you don't have to track reinvestment, so all that is very easy to manage because all that is taxed anyways. So like there's no contribution rooms you need to fine tune. So if I were to take some of that money, it would be that 5% of the non-registered and margin account that I'll be taking from. Maybe in one particular month, I might go somewhere and just like relax on the beach somewhere for a couple of days. But based on my entrepreneurial mindset, it's I'm not sure if I would be psychological fit to like go screw off somewhere in the middle of nowhere for like
This
5
is this
years.
is this is your dopamine. This is your fun.
Exactly. Yeah.
Yeah, don't change. Do what makes you happy.
And
There's like, yeah, go ahead.
maybe I've been looking at more YouTube videos now, like potentially building, like maybe doing international trade overseas. Like, 'cause I do like that travel perspective of like seeing the world because I haven't really traveled anywhere. Like throughout my life, I've gone to the US a couple of times. I've traveled throughout Canada a couple of times. I've gone to China a couple of times because the vast majority of my extended family is in China. So I go there every 3 to 4 years, every 3 to 4 summers. Less often, less so now because of school, because of all the different avenues I'm doing. And so it's hard to basically put like a, it's hard to explain, but it's kind of put like a stop on your brain because like I've gotten to the point where it's like, oh, if I'm not doing something in that particular moment, then I'm not feeling productive.
Yeah, that's
You
definitely.
probably get it, right? So it's like, I don't know,
That's my
maybe
yeah.
maybe in the future, like I do want to maybe diversify and broaden into like international trade, international commerce. I might go travel overseas, scope out a landscape and see if there's a possibility to maybe build a local business doing there. Maybe I'll do something that because I feel like maybe it's not necessarily for the money. It's just the fact that I feel productive. I'm doing something passionate. I'm not just like relaxing on the beach and not doing anything. So, because I feel like a big part of all of this is very psychologically driven. So, from a financial perspective, it makes sense. From a psychological mind shifts perspective, like even shifting from a more growth focused to an income focused, but like growth vehicle.
Inc. Yeah,
You
yeah,
know,
yeah, yeah. I
all of
get
it
it.
technically treated as a growth vehicle right now. It's because everything is reinvested. That was already a mindset shift that it took about 2 years to really get it. Then, but everything is still, but then from a work perspective, that psychological shift is going to be, is even a bigger step. That's probably going to require some kind of fine tuning. I don't know if you have any tips on that perspective. Like, were you always just like super driven too?
More or less. There's nothing I can do about it.
Yeah.
I've actually tried to chill out and I get depressed. So I
It does feel
realize
a little
this
bit
is my
depressing. Yeah.
I need something I'm passionate. So hyper obsessive personality is what I have. So like I don't have like Like I don't get like, oh, I'm into something 1 second and then I like move on to the next thing. I
hmm
get into something and then I'm into it forever. And
Right.
then I focus on it. And then if I start something, I have an obsession of like, okay, now I have to be like like I have to like figure out how everything works. And I won't stop until I'm highly proficient at what it is. So like even you making YouTube videos. Like this whole channel, I'm like, oh, I'm not gonna stop until I get 100,000 subscribers. Because I was like, why would I even start this thing if I didn't want to get 100,000 subscribers? That's
Right.
pointless. And if I don't figure out exactly how to craft videos, talk on camera, I'm like, why am I even doing any of this? I should
hmm
just do it if I'm. And so then I got obsessed on content creation, all that kind of stuff, and doing all that stuff
hmm
with investing the same way. How do I maximize everything so you end up in value investing? So we'll talk a bit about the psychology. So I have tried to be like, Gary, hang out and like do nothing and don't have goals because like my goals
Yeah.
will always be like mountaintops, every single one, because like
hmm
they're not interesting to just kind of achieve something.
Right.
And then I tried to do that and I did it to kind of fit in. It was like first everyone's like, oh, what you're doing is stressful. I'm like, I don't feel like I feel like I like it. Why else would I be doing it? So
It's like
I
a
listen to
dopamine
people.
dopamine hit. You don't. It's not like a
Yeah,
negative stress. It's like a positive stress that's like building it by itself. It's like a rocket ship of sorts.
but I changed because people around me are saying, no, do less like us, do less like us. And I go, maybe there's something wrong with me. Okay, great. Maybe I will take a few steps back
hmm
and I'll do less. And I got depressed, I got sad, I got demotivated, and I
Oh,
felt like
okay.
I wasn't even myself anymore. I felt like I was acting like someone else who was trying to fit in. And then I kind of went, F that shit. I'm just like this. It didn't last very long. I went, I'm just gonna go balls to the wall. Like that's what I like to do. I've been doing it since I was a kid.
All
I
right.
just pick shit. I pick stuff to do that everyone thinks is impossible or doesn't make sense. Or people go, a lot of people tell me, no, don't do that. Cause they're like, in their brain, they're like, I don't know how he would achieve
hmm
that goal. Like,
Right.
how is he going to get there? I don't see it. So how would he see it? Well, I see it typically very clear. And I know I have to take a bunch of very difficult steps to get there. You don't build a business by accident. You don't
You
build a
don't.
massive investment portfolio by accident. Like none of these things, and right now you're launching a YouTube channel, like mine's growing at a steady rate. None of this happens by accident.
Right.
It's because pick these lofty goals, do stuff that's uncomfortable, do stuff that's very difficult, but it feels fantastic doing difficult shit
Yes.
and getting somewhere. Even failing at difficult shit feels pretty good because failure in my brain is just,
It brought you
okay,
somewhere, right? That you can fine
what did I
tune.
get from the,
hmm
yeah, fine tuning. That's what failure is. It's not even like a bad thing. It's just like, okay, what didn't work? Okay, great. And from life experience, I'm a lot older than you. You learn that
Not that
failure is
much
just moving
older.
you. I'm 40, bro.
Oh,
40.
that's
Yeah, I'm a
fine.
lot older. Okay, you could be my child. So actually, okay, you're my smart child. I'd be very happy if you were my child. I'd be like, look how smart my kid is. But my kids are actually 2 and 3. But like, it's failure will just move you closer to your goal. So whenever I'm failing consistently, a
hmm
good and I've learned from experiences, good. I'm failing a lot, which means I'm doing a required amount of work. So if I'm not failing, I'm not testing and iterating fast enough.
Right. Yeah.
It's like I'm taking too long to get shit done. But if I'm always failing, I'm going, okay, perfect. I'm like constantly trying things. I'm
hmm
constantly
Yeah.
trying things to move towards it. I'm not just randomly trying. It's a calculated try. And so, but like even me talking about it, it's like I get excited about it, going like, this is dope.
Yeah.
Like I
You can
love
hear the
this.
passion.
Like
That's
yeah,
important.
it's like, and maybe because I came from playing video games as a kid, and I talked about this in a previous podcast, is about leveling up your character, getting
Yes. Yeah.
stronger. I like the auction houses in games, buying and selling things, the economy in the games. I like getting my character to level 60 and becoming the best hunter. I'm like, well, I just gamify my entire life. I like watching
That's
my
so
investments
cool.
grow. I like getting stronger. I've been working out. I like building my family. So like
Yeah.
it's the same. Like, I like making everyone happy around me, boosting everyone's mood. Like
hmm
these are all things I like building throughout life. So life has just been gamified. So
Oh yeah.
dopamine, and what's a better dopamine hit than a video game? Your actual life. So that's all it is. So it's like, why would I want to put a cap on that? Why would I want to stop and just chill for a second? It
Right.
would.
Yeah.
I've tried it. I'm sad when I do that because I'm just like, oh, I'm not, because I think I know I've lost my health. I talked a little bit about I completely lost my health when I was a little bit older than you. When I was like 26, 27, it was taken from me. I
Oh, okay.
realized I have a rare autoimmune disorder that basically shuts down all my organs. And I spent basically 5 years in the hospital
Oh,
taking all
okay.
these medical treatments. But I came out of it. But in that moment, I learned, I went, whoa, your health and wealth can be taken from you in an instant. And then at that moment, I actually did have all day to sit around and chill. I was in hospitals all day, but I was sitting around doing nothing. And I spoke to my wife, who she's now my wife, she was my girlfriend at the time. I said,
Mm-hmm.
if I'm ever able to move again, because I had no function in my hands, I couldn't walk. I was like, if
Oh
I can
my.
move again, I'm like, if I can move again, I'm gonna do everything I want to do unapologetically, and
Mm-hmm.
everything I want to do, and not hurting anybody, just like everything that's good that I want to do. And I'm going to run more. I'm going to walk more. I'm going to get outside more. I'm going to work towards every goal that seems impossible that I've always wanted to. I'm just going to do it
Mm-hmm.
because I
Yeah.
realize how valuable having energy is and
Oh
being
yeah.
alive is. It's like, and having your mind work. I'm like, I don't even need my body to work because my body was broken for years, even after I got better. I only started feeling better. Like my body started working in my mid 30s because I had so much damage from all the treatments, from all the autoimmune disorder. It took me like years to actually get like my strength back.
Mm-hmm.
So, but while my body is broken, but I wasn't dying anymore, my mind worked. And I immediately just started working towards my goal. I became a millionaire with no body, just my brain. Right. And then,
Wow.
and just sitting around
That's
because I was like, all
inspirational.
right, I'm like, I got energy. I can use a laptop. I didn't have use of my left hand. Now I had both hands. I'm like, dude, I got both hands working now again. And I have more than half an hour energy a day. And I'm on the hospital all day. I'm like, oh, I got like 4 hours of productivity. I'm going to cram this bad boy out. I did it all doing under those circumstances. So I think there's a lot of that in me because I know what it feels like to have everything taken away from you at a fairly young age, going, oh shit, I think I was taking a lot of shit for granted. I'm only gonna do shit I like. I like just doing cool shit. I want to keep thinking of cool shit. And I realize when you're passionate about doing cool stuff, you can
Mm-hmm.
monetize it. There's money to be made because you get very, very good at it. So I, I don't know where I was going with it, but it was more on follow what you like doing. Don't take
Yep.
your energy for granted, and don't try to, like, I'm not saying go travel, like, because that's what other people do. It's like, screw what other people think you should do. Just be very honest with yourself and be like, what do you like? What is your sensibilities? You as a human being, and if you're not hurting nobody, and you're not doing anything bad, and you're just like, hey, try and do the right thing, go do whatever that is, as random as it seems. Like, just go for it. And if you know
Here's one question. How has your girlfriend and wife dealt with your current mindset of like always doing something and not really relaxing? Like, how does she deal with it? Because I'm kind of basically facing the same thing
struggle.
with my significant other.
It's a constant struggle. There's not the whole lot you can do about it. So it's more like, it's me being cognizant of, she doesn't want to deal with it all the time. Of like, she doesn't want to like hear about, okay, what's happening with things we're working on all the time.
Okay.
She needs the Real Housewives or something. She needs all that, right? And we also have
Mm-hmm.
the kids. So what I do is I'll give it to her in micro bursts of like my energy of like, here's what we're doing. But for the most part, I try to just like understand, okay, I'll make it about her.
Mm-hmm.
And I give her and because we're working on so many things, when I'm with her with the kids now, and this is on me, I try to not focus on anything else at
Right.
all. So it's pure dedicated. So when she's looking back and she goes, okay, well, when I had him here, like when Gary's not working, when he's with me, when he's talking to me, his mind's not somewhere else. And when he's sitting with us as a family, his mind's not somewhere else. So regardless of what that time allocation is, he's 100% present. So
Okay.
I think that alleviates some of it, where it's just like, okay, I get it. But then you have to communicate. And it helped me a lot when I communicated, hey, I
Mm-hmm.
tried to do the let's be passive 24/7 and I was miserable. I can't do that. And when your partner, it's hard a mental adjustment. Like, how could you be happy like this? But it's
Yeah.
when it clicks with them and they go, wait a second, that's their happy place. I'm like, this is my happy place. When it's 2 o'clock in the morning and I'm building out a new idea, that is my happy place.
Mm-hmm. I
That's
feel
where I
that
feel that
completely for sure.
that's it. But you got to like communicate it and just sincerely just say, like, it sounds weird and we're all different, but that's just my place. Like when you watch your show, when I'm doing this, I feel that same effect in my brain. Like I feel just as good. I'm like, so that's why I don't want to stop it. It makes me sad. That's why. And when I started, and I didn't communicate that. I was just being like, how do you not get this? When I started communicating emotionally, like, this is just like, I honestly, I feel good. Like, I've tried other stuff. It doesn't work. This is like actually what makes me happy. Then she's kind of like, okay, I get it. But you have kids and you have a wife.
Right.
So when you're with us, we just want you. And I'm like, fair enough. Like when you go to fam, that's not even a compromise. I want to be with you because my
Mm-hmm.
brain needs a little bit of that time to relax, boom, and I come back more energized to do the other stuff.
Right.
But then I just pivot that energy onto them, and it's great. And it's like all about them, all about them. But it's goddamn it. You have to be super communicative. You got to be very considerate of how they're perceiving what you're doing and trying to communicate. Like, here's the thought process why I'm doing it. Don't get defensive about anything. Just like communicate. And if they're like really not getting it, you just gotta be patient and be like, and then like my thing is, I can work for 18 hours straight, right? I can go for 7 days a week. I can go for years on end and just grind towards something and keep going. It's just like reassuring them that hey, this is just how I operate. This is like, this is my norm. And by the way, I still have time for you and I value you. It's like letting you know that you're not secondary to this thing.
How much time do you usually set aside for your family compared to building everything else?
So I'll tell you my schedule right now. So at 5 p.m., no matter what I'm doing, I'm off and I'm with my kids. Go to bed at they go kind of late, like 9:30.
Okay.
I put my daughter to sleep. My wife puts my son to sleep. I tell her stories. I'm with her the entire time. And then me and my wife will hang out, watch TV till like 11 p.m. or something, right? Hang out. And then from 11 to like 2 a.m., sometimes 3 a.m., I'll work again. And then I'll wake up then I wake up at like, depending on the day, like sometimes I work up earlier today. I wake up between 6, some days, my wake up day is different because I have clients too. I wake up between 6 a.m. and 9 a.m. Monday to Friday. That time changes. And then I'll spend the mornings with my kids a little bit. And then I take multiple breaks every 2 hours, every hour and a half. I'll go upstairs, see what everyone's doing. I'm in my house, by the way, and I can't see what everyone's doing. Ask my wife, she needs help, come back down. So my day's broken up into these 2-hour increments. So I'm seeing that. So my kids see me during the day every 2 hours. Then they're with me in the evenings the entire time. But I'm working late at night as well. And then on weekends, I wake up in the morning and I'm with my family from morning to night the entire time as well. I would say 50% of my time is with my wife and my family. 50% is at work. I just work in the nighttime as well. So I do 8 hours during the day, then I do like another like 3 hours a night. I'm doing like 12 hours a day. And I just rinse and repeat. And sometimes on weekends when they go to bed, I'll work until like 2 a.m. as well. And I'll just keep going. It's a long day. Yeah.
When do you sleep?
I just told you that's when I sleep. Yeah.
Wow.
And then every once in a while, no, weekends I don't get any sleep because I wake up super early. A lot of times when in the morning, like if I try, realistically, I don't even sleep past 7 a lot of times because what happens is if I try to sleep in past 7, like sometimes I'll sleep until 9, but it's only because my wife allows me. But my daughter will come in to the room and be like, "Hey, Daddy," and she'll get into bed with me,
Right.
and then she'll want to so she wakes me up no matter what at 7, and that's just a schedule. And then we go, and I just go. And then I don't have a lack of energy. I get blood work done. I got a DEXA scan coming up. I'm running fine. And if I get 8 hours, I feel kind of sluggish. If I get like 4 hours, I kind of feel weird. 6 hours, I always feel good. And because my days are long, I'm like out and then I'm awake. So it's like, I think I'm getting quality sleep in those 6 hours. I think that's what's happening.
Okay.
Yeah.
Do you track your sleep patterns?
Yeah, I got a wearable.
Is it accurate? Like, is it actually helpful?
It's fairly accurate. Like I look back, it's close enough. It'll definitely tell you when there's giant discrepancies of like, oh yeah, it's a little off, but it's very obvious when it's off. So like 4 less hours is off, and 4 hours is actually okay if it's like dead sleep the entire time. But if it's like a broken 4 hours, so I think it's more about quality of sleep than quantity with me.
Yeah,
if I can get super high quality, then I'm good. And you ever been on vacation and you're on vacation, not getting a lot of sleep, but you're energetic the entire time because you're on vacation and you're waking up and you're ready to go somewhere. Like, all right, great. We're waking up. We're going somewhere. We're going checking out the tours. You're up all night with everyone. You had a great time. You went to the Blossom tour. You're hanging out with everybody. Then you go to bed, barely get slept, woke up and you're just energized again and you're ready to go. That's how my days feel.
Every single day.
Most days, unless I'm like sick. So it's just like, oh, what are we doing today? Because nothing I'm doing is some bullshit. Like, oh, great. My daughter just woke me up at 7 o'clock in the morning and wants to tell me about her dreams. Yeah, well, I'm all for it. Tell me about what you dreamt about. Let's do this. Let's talk to me about your dreams at 7 o'clock in the morning. Let's do this. Okay, great. I'm literally working at 8 o'clock in the morning. I'm like, great. I'm going to hop on a call. I've been wanting to talk to you for a while now since I actually met you. Like, this is great. get to put a voice behind the face. You know, I get to know you better, right? Because like we talk so much throughout the week. I'm like, this would be great to actually sit down and talk to you properly.
Yes.
So like so far, my morning has been I hung out with my daughter, and then I turn on a camera, I talk to you.
Okay.
Is there any lag for me to be miserable in there? And then immediately I got some client stuff. All the clients I work with are awesome. I'm gonna go have lunch with my wife probably at some point, like a late lunch. So what's happening here? That sucks. Like I went from a guy who I was dying in a hospital bed a decade ago to now. Like what am I talking about? So the energy level is very easy to maintain. At nighttime, I start crashing. At 1 o'clock at night, when I'm like, there's a podcast edit because haven't figured out how to get my editors to edit the podcast effectively yet. That's kind of painful. But I'll put Lord of the Rings on in the background, my favorite movie, and I'm like, all right, well, what's Aragorn doing? Oh, that's neat. And then like editing the podcast, it's not that bad, right? So, and then I just kind of fall asleep, and then it is what it is.
Like, you fall asleep at your desk?
I fall asleep in our guest bedroom. So when I'm doing late night editings, because my wife gets annoyed, I'll edit in the guest bedroom. So I'll have my laptop open and I go and I'll fall asleep in the actual bed. Yeah, not here. Or if I have energy, I'll get up and I'll walk to the bedroom and I'll go to sleep. One of the two. But a lot of times I have just fall asleep in the guest bedroom sometimes and edit, and I just wake up and go. That's common too. It just depends. But I only do like one podcast edit a week anyway, so it's not too big of a deal. But that's sort of like the routine. In the evenings, I don't work from my desk. So I take my laptop and I go upstairs into our living room, and then my wife watches her shows, and I'll just have my laptop open and I'll just like do work here or there a little bit. But sometimes I don't even do that. Like I'll just sit and watch the shows with her, and then like she'll just like tell me what's happening, all the different dramas and stuff. And I'm like, oh, okay. And then we just like chat.
One thing about that, does your wife ever get annoyed? Like, say for like, even though you're hanging out in the same room, but you're not interacting with one another, where you're really just focused on work.
Yeah, that's why super annoyed. So that's why I don't really do that as much anymore. I'll actually wait till she goes to bed. Like sometimes when we're really stacked, I'm like, hey, I'm just gonna work beside you. But I kind of announce it. I'm like, I'm just gonna work beside you. I might not be responsive. I like to say I might not be responsive, or there'll be a massive delay in responding, or I'm gonna put some headphones in and then I'll do it. And then she's like, okay, I got what you're saying, and then I'll do it. But for the most part, I try to even have that away and just like be there, because she's got a whole day she wants to tell me about. Like, okay, download the day into me. Tell me what happened. Because even if I'm going up and down throughout the day, she's with the kids running around doing stuff. It's like hard to properly communicate. So that's like her time to like chat, tell me what's going on. What am I? Whatever. But it's more me listening than talking. So, like that's mainly what's happening. I'm just listening most of it. I'm like, trying to be like, oh, I get it, but I don't. Do I get it? Like I have no idea. I'm just kind of listening to what she's saying. But yeah, that's it. That's the routine, though. That's my life every single day. That's
That's fascinating. Like your brain is built in a very particular manner. Yeah, you're just different.
I hopefully not in a bad way. It works.
Oh, no,
for me.
like unique.
It works
like,
for me.
Very different.
Yeah, it works for me. And then it's just like I constantly hear about it from my wife and like family and friends and stuff. There's like, what is going on here? I'm like, it is what it is. I don't fight it. I embrace whatever I am. It's really important you just embrace whatever you are and never feel weird about it. Like you kind of, it's very natural to feel like an outsider, especially for me growing up. I always felt like there was everyone and then there was me over here, and almost observing everyone from a distance and being very observant. Maybe why the podcast works so well is I'm so used to listening to people.
Right.
Like I do talk a lot on the podcast and I get a lot of slack for that. But
why? I mean, like technically a podcast should be a conversation, you know, between the two people.
I'm trying to talk to somebody. Don't I have to say something?
Exactly.
But it's always felt like
it's always a conversation between two people, because there's always different perspectives, which means it actually adds to a conversation rather than one person talking and one person listening. There's no dialogue, you know, it's just spitting out facts. There's no actual conversation. So I feel like that's always what a long-form podcast should always be about.
Everybody has, but you know, there's a lot of opinions online. But you know, for the most part, everyone's really cool. Yeah, but everyone's actually pretty cool. So I can't. People get a lot of hate online, and I think I've dodged a lot of that just because.
What kind of hate do you usually get?
Not same stuff of like you talk too much. I get like a long round one that you talk too much or you move your hands too much. I'm like, I don't know what to do. I have hands.
Yeah.
And you'll get the most weirdest things. Like, hey, I get this a lot. You talk too fast or you talk too slow. And I'm going, what? Because sometimes in my educational content, I'll talk purposely very slow because I'm like, I have to say like a lot of stuff.
Right.
And sometimes even for my older audiences, I'll put captions on, and one will say, I love the captions. Another one will be like, remove the captions. Another one will be like, talk faster. And on the same video, talk slower. So I go, I don't know. I don't know what to do with this. So in the end, just do your thing.
Yeah.
Let's move on to let's power through this list.
All right.
Because I know you probably got to go to in a bit here. So
I'm technically on vacation, so
okay, perfect.
Yeah.
Okay, I didn't know how long I had you for. If I have you for a little bit, I can work through this list not as fast then. Okay, all right. Let's go to number. So we're only at number 5 right now, guys. Now let's go to HYLD. This is a podcast structure. We go all over the place to get to these these holdings, man. So if you're at number 5,
because I mean, technically, like a portfolio is just a portfolio. There's not that much more you can say, but it's really, I guess, the mindset, the thinking, the dialogue.
That's what matters.
Yeah.
The why is what matters. The psychology and who the investor is. You need to understand, who JJ is, who I am. Then you understand why you make decisions, and why our decisions don't apply to you first, and when sometimes why they apply to you. So we have HYLD, Hamilton Enhanced US Covered Call ETF. So this is another one, another Adriano type one where I don't know if he still does. He still hold it?
He does. Yes.
HYLD,
He actually, in his latest portfolio, which he posted last night, he got rid of all of his USCL positions. So all he has for S&P 500 is the HYLD position. I'm not sure why he decided to pick HYLD over USCL, but yeah. Yeah,
that's interesting.
Especially since, technically speaking, if you look at the long-term track record of basically when HYLD became the new HYLD 2.0, which was about February 1st, 2024, if you still start from that point, because mostly the only difference between HYLD and USCL is the Canadian hedging, which is HYLD, and USCL is unhedged. And that if you want to actually break down the sectors, even though HYLD sector, it's sector-like compared to the S&P 500, like in terms of portfolio allocation, like the breakdown percentage-wise, it's very similar to S&P 500, but it does not hold all of the holdings of the S&P 500. HYLD technically only holds about maximum like 80 unique positions of the 500 of the S&P 500. So it's technically a bit more concentrated. And there is some other, so there's some REIT position. There is a REIT allocation, so like 3% RMAX within HYLD, which is not inside S&P 500, which is technically USCL. And then there's actually, according to the latest breakdown of Hamilton, which I actually looked at this morning, Hamilton actually included, I'm not sure if you actually noticed, because previously they had they have about 65% position in SMAX, which is the US leaders, which is about 30 positions. And then they have about 25% allocation to QMAX, which is the technology allocation of HYLD. And then they have a 5%, I think 3 to 4% position in HBND, which is the bond position. They have 3% in RMAX. And then there's a 2% position in AMAX, which is the gold producers. But then since about, I think a couple of days ago, they actually decided to add the 2 DayMax positions. So SDAY, they added 4% SDAY position to HYLD and a 3% QDTE position to HYLD. So now I used to beforehand, I always just added to USCL because I don't necessarily like the fact, because when you own an index, you kind of just want to own an index. You don't want it to change too much because HYLD is index-like, but it's not the actual index. You're still stock picking as part of the index. There's always trimming, there's always optimizations, there's always changes. There's a good thing when you have stock picking versus holding the actual index. The entire index will capture all the movements of the index, the goods and bads. So the bottom positions of an index, when they outperform top positions, that index will capture it. However, when you have a concentrated list of an index, you won't get those positions. You see where I'm going with this? So, but plus the fact that I usually like to hold the unhedged version. So, VFE, it's unhedged. there are some minor influences of the Canadian dollar that will impact the long-term performance of VFV versus VOO. If you actually look at the day-to-day movements, VFV and VOO, there are differences based on the fact that a Canadian and dollar versus US dollar is always differences. But from like a global perspective, I always like to hold unhedged positions, unhedged to Canadian. So I would technically prefer VFV over VSP. So that's why originally I had only held USCL. I didn't really care about HYLD because, yield is the same. Hamilton usually likes to be more aggressive with their call positions. So they're usually always at the money, but then lower ratio. So they're usually capped at about 30%, even sometimes even less. So like 20 to 30% capped ratio, but then super aggressive on the premiums. So take your pick, right? So would you rather have more coverage up to 50%, but more out of the money? There's technically more room for upside, or would you rather be more aggressive, 20 to 30% coverage, but more at the money or maybe in the money? So it's technically higher risk calls, but you get a lower coverage. So I guess take your pick with that. So because of the fact that HYLD is more concentrated, I'm talking about HYLD 2.0, not previously HYLD.
Most people
was something else entirely, which was garbage. Like I actually held the original HYLD once it released, and because of the fact that all of the positions inside HYLD, their strategies were mostly on the JEPQ, the JEPB, the JEPQ, the QILD, XYLD, RYLD, all the very old school. So 100% coverage ratio at the money, automatic reinvestment. Because of that, it's very old school. It will not perform well with the indexes. So what Ben Felix referred to those kinds of cover calls, he is right. They are terrible in terms of total returns. You should not be sacrificing total returns just to get income today, because you will be losing a lot of money. Even that 1% difference compounded long term, and the fact that 1% is based on the entire portfolio value of what you have, it will be a lot of money. So don't sacrifice income today for like returns tomorrow. So what he said on that, it is very accurate. And plus the fact that because all of those are US positions, Hamilton loses 15% off the bat. So that's why they're because of the old school tradition, because of the old school strategy, and then the 15% that Hamilton loses for each monthly distribution, and because they are high payers, you lose more of that 15% distribution. So everything adds on. So HYLD 1.0, that was, I don't want to say garbage, but it was pretty garbage. So when we're referring to HYLD 2.0, I don't really see like a difference with USCL. I like the unhedging position because long term, US dollar, looking at a long term position, US dollar is technically will perform better than the Canadian dollar. So I always like the unhedging when it comes to my stock picks. But I had added it to, so I only hold HYLD in my margin account. None of the other accounts, just my margin account. But because of the fact that I really like the DayMax positions of QDTE, SDAY, and CDAY, and the fact that they add a little bit of it to both HYLD and HDIV, which is the Canadian version of HYLD, now I might be looking into adding HYLD into my other accounts. I might add a bit to my TFSA. I'm not entirely sure just yet, but as of this moment right now, because of the fact that it is still Canadian hedged, I have it just in my margin account and not in my TFSA, which is all unhedged. Well, 99% unhedged. And yeah, that's that.
Are they gonna increase the percentage allocation of SDAY QDTE, do you think?
I think because of the fact that they are performing very well, because they are just looking at the breakdowns of the DayMax structures, 100% allocation of their actual holding is uncapped. and their holdings are uncapped. They're just regular positions, because what does CDAY hold? CDAY holds the 100% CMVP, which is all Canadian aristocrat payers. You can kind of think of it as VDY or XCI, which are, so it's like a 100% position allocation to VDY, which is uncapped, plus a 25% leverage position on VOO, which is where they're doing their daily at the money calls. So they don't have any actual, you're not getting any of the allocation to the S&P 500. That is purely for the call premiums, but you're getting 100% uncapped position on VDY or XCI, and they're technically speaking, they're doing very well in terms of the Canadian space. For SDAY, same thing, 100% SMVP position. You can kind of think of it as a good complement to the SCHD, the Schwab US Quality Index. It's kind of like the holdings are very similar. They're probably not exactly the same, but you kind of think of it as a good complement to SCHD. So 100% allocation SCHD plus a 25% allocation to call writing premiums of VOO. So I think it's a great long-term growth, dividend growth position for that. And then yes, go ahead.
So I was gonna think I was thinking of getting HYLD in my non-registered account and possibly building that over USCL first. Does it make a difference, or if you had to pick one to build from now, knowing that SDAY
for non-registered account? Because so if you look at the breakdown of HYLD versus USCL from a purely performance perspective, long term, USCL may still outperform slightly, just because of the unhedged versus hedged currency, because HYLD is still hedged. USCL is still unhedged. They have the same management fee, 65 basis points for both, so there's no difference in that. If there was a difference in management fees, then I will probably then go with the lower expense ratio, but they're the exact same. Because there are also, you could argue that, maybe the leverage costs could be different, but they are huge fund managers. Their leverage borrowing costs are going to be way less than what we can get as DIY retail investors. So it's pretty much neck and neck. You can't really, there's almost no difference. There might be a very minute factor, but it's not that much different. And so the only differences could be that HYLD does have some Canadian, some minor Canadian allocation under RMAX, under AMAX, under EMAX.
Yeah.
So there's going to be an eligible dividend component, maybe like 5%, right? Because HYLD also has, and then there is maybe like a 1% allocation to foreign dividends, other income, because of that SDAY allocation. Because remember, 100% of that SDAY allocation, they are US dividend aristocrats. So that dividend paying portion is non-eligible dividends or foreign income. So from a purely tax perspective, HYLD may be less tax efficient, especially since you are in such a high tax bracket. But from a performance perspective, it's really hard to say if they're going to be, maybe USCL might perform a little bit better if the US dollar is a bit stronger because it's unhedged. HYLD will perform better if the Canadian dollar is a bit stronger because it's hedged. I would say because the differences are so minute, it could, if you don't care, you can always hold both or pick one or
just go with the fund that I like the most. Because
exactly.
I have, I'm a little
because the differences are so minute. It's
I like that.
It's kind of like nitpicking. It's nitpicking,
nitpicking
basically.
is good. That's a good problem to have.
Yeah.
I like Hamilton in general just because I've had a good relationship with them for a while, just through advertising and stuff.
Right.
So that's actually why when I first started making cover call videos, I actually bought Hamilton ETFs first because it was a one I knew. I bought HMAX, UMAX, and HYLD. I actually used to own HYLD. I sold all of them, and I just went crazy with higher yield and all that stuff. But I started with Hamilton purely based off of I know these guys, I know they're good for it, and that's where I started. So there is a bit of that in me. I was also thinking, we can talk about this later. I was like, maybe I should just go Big Y, SDAY, QDTE, my non-registered, go all by 2 times a week and just go hard on that, and
You
then
could.
maybe like an then like an HYLD or a USCL, like one of those only, and then build up that, and then just have like 25% in that in one of those, and then the other 75% of my portfolio, 25, 25, 25 in Big Y, SDAY, QDTE. Boom, I'm done. All American, all return of capital, all
Mm-hmm.
no Canadian dividends. I get those bi-weekly things. As a YouTuber, it gives me plenty of things to talk about
Yep.
because I'm
Yep.
getting paid twice. I have to consider this, by the way. I
Yeah.
consider that when I'm buying stuff of like what gives me the most to talk about and report on.
Right.
Because it has to hold multiple values for me. Like,
Yeah.
okay, is this something for content ideas as well? So I consider that. I go like, okay, well, this will hit all those things. I can talk about every 2 weeks. I can say, here's how much I got paid, and make a video breaking it down, right?
Exactly.
Rather than every month.
Because
I
if you
think about this.
buy purely just from, if you just buy VFV, well, it's not much you can talk about. It pays
Well,
like
that
what,
one
like
video.
twice a year? Is that it? Like twice a year or once a
Maybe
year?
I maybe a VFV video coming out in a couple of days, and it's just
Okay.
basically saying, it's great. It's the best one ever. You should
What
just
can you
buy
talk
it.
about? It's great. It holds the top
And I
500 companies. It's already diversified globally. Like there's not much
only
you can
make
argue about
VFV
it.
videos. I make VFV videos for one reason. It's because new investors are always starting.
Too risky.
And it's basically, even if I've talked about it though, I talk about it again just to capture that person who just started investing this month. My video will pop up in the algorithm right
Yeah.
away, and then be like, oh, okay, here's the most up-to-date information on VFE. It's not for someone who already knows about it. Like VFE is pretty, you can say it in like one sentence of what it is, and like, oh, I get it. Okay, the end. But it's just for a brand new investor who doesn't even know what an ETF is. I go, here's a beginner-friendly video. So
One thing, if you're targeting beginner investors, because of the fact it's like its price, it's so expensive, it's like $160. So like if for comes to beginners, maybe they don't have that much cash allocation. So a really good equivalent, which is the exact same thing, I'll probably go with the BMO equivalent, which is ZSB. The same thing.
yeah, I think
It's like it's also trading at like what, $30 or $40, much lower.
That's what I
starting
mentioned.
cost.
That's what I mentioned.
Yeah.
So the video itself is called the most bought stock in 2025, and it goes VOO and SPY, but then it goes, hey, the Canadian equivalents are VFV and ZSP, right? That's the
ZSP,
BMO
yeah,
one.
exactly.
Yeah. And then I basically just go like, those are the two you'd get in Canada, and then I kind of break down more VFV and ZSP, but I the hook is VOO
Right.
and SPY because they're the most prominent ones, but I just break down the Canadian. So I actually do mention it. It's the
SPY is actually not an ETF. It's technically it's like a mutual fund. It's an indexed mutual fund. So I'm not sure. It's like its tax structure. It's kind of weird, but it's not treated as an ETF, which means that you can only buy and sell it at start and close. I think.
Really?
Yeah.
Oh, I didn't know that. I didn't know that.
Because because if it's not an ETF, then they're not very heavily liquid. Don't quote me on this, but there are regulations when you can buy and sell it.
I thought the whole thing of SPY was that it was highly liquid. That's been like the main draw for it. I thought it was the fact that it's the most bought and sold. I don't know enough about SPY because I never bought it or did it. I just went for VFE because it is a lower expense ratio, and I mean VOO had a lower expense ratio when I first started investing.
Yeah.
Okay, let's move on to number 6, ENCL, Global X Enhanced Canadian Oil and Gas. Now that it's Canadian oil and gas, I guess this wouldn't work very well in my non-reg either. Anything Canadian?
Energy pays. Kind of think of it as bank, except when it comes to energy, like the top 10 oil and gas. There's also pipelines. So there's Suncor, TC Energy, Pembina pipelines. There's Fortis and Bridge, all the top Canadian oil producers, oil and gas producers. So it's in terms of like a tax perspective, it's very similar to bank. It's also leveraged 25%. So, but when it comes to financials, it's more boring than energy, because energy is more influenced by world news, world economics. You'll notice that during the whole spiel, like oil actually fell down, like ENCL specifically fell down to, I think the lowest was like 1650. It usually trades like what Perry said when it comes to like these more non-diversified, so sector-specific positions. It's not necessarily NAV erosion, it's trading in a price box. So when it comes to ENCL specifically, the lowest it will go is about 1650. The highest it's ever went is 2050. So strategically speaking, you would probably want to buy it at on the lower side, and then you can sell it when it reaches like $19, $20, say for example, and now around this time period. Like I actually, in one of my accounts specifically, I bought it too high. In my margin account, it's like the average cost, it's like $19.80. So that's why this morning I added a bit more just to bring down that cost. And then I actually sold part of my ENCL position, like 250 shares of it in my TFSA specifically because I was pretty positive on that position. My average cost in my TFSA specifically was around that $17 range. So because of the fact that my TFSA, it's more US focused. The only reasons I bought it originally is because, kind of yield focus, it was paying a great yield, it was like 17%, but the long-term perspective, my TFSA is served as a bit more, some growth, still income, but more leaning towards the US sector. So that's why I trimmed that ENCL position. No taxes, it's just an TFSA, don't have to worry about it. And I bought BIGY and HBTE instead. Okay, yeah. So I was saying, so I traded, trimmed that ENCL position because it wanted a bit more US focus, because in terms of the one big thing in terms of options and premiums, the US stock market is always going to be more volatile, more liquid, and so higher premium options, like there's going to be always going to be higher liquid options in the US market compared to the Canadian market, regardless, because normally those sectors in the US are more tech heavy, more influenced by markets, more influenced by market news. So what does that do? Higher volatility, higher premiums, higher strategic rebalancing potential. So that's part of the reason why, I'm not even touching my TFSA anyways, so they're all on manual drip. So it makes more sense to trim those Canadian positions, which are pretty boring. You can't get that much more premiums than what it already is at. Like 16% is already, I would say it's pretty much capped already in terms of what you can expect from the Canadian market. So like 16.8% range. So trim that position, add it to BIGY and HBTE, which is the crypto position.
The next one we have is an American one now, YMAG Yieldmax Magnificent 7 Fund.
Yes.
Why'd you get this one?
Originally I bought it 2 years ago because actually about 2 years ago, give or take. It's the Yieldmax Magnificent 7. So it's like a basket of all the 7 Magnificent 7 holdings. So their particular structure is very interesting, whereas they pay so they're a weekly payer. So that's number one off the bat. So they pay every week. So they have Tesla, Google, NVIDIA, Microsoft, Apple, and was that 7? I think that was 7, right? Am I missing one?
Close enough.
Yeah.
Close enough. Is this in your TFSA?
Yes, it is in my TFSA.
Okay,
so it's part of it is in my TFSA, part of it is in my margin account, and I have a small allocation in my RSP as well.
How do you use that margin account? Because I know people who use margin accounts, but they're writing covered calls themselves.
I'm not doing any of that.
What are you using? You're using the margin on these ETFs. Can you explain? Can you walk me through that a little bit?
So what happens basically? So you're basically borrowing money to buy more. So every time, so I look at it as, because in Wealthsimple, every time you need to get US dollars, if you want to buy USD specific holdings, you have to convert it yourself. And because Wealthsimple doesn't have that Norbert Gambit option, and if you're converting like smaller dollar amounts, say for example between $1,000 to $5,000, if you're buying less than $10,000, that Norbert Gambit doesn't really make much of a difference. Like there's no big difference, so it doesn't make much sense. So every time you do have to trade it, you have to pay. So Questrade charges 2% for conversion, and then Wealthsimple charges 1.5%. So with that margin account now, if you want to buy US dollar positions, you can actually bypass that conversion fee because you're borrowing that money anyways, and you are basically buying those USD holdings without doing those conversions. And then at
Oh,
at
I
the,
get
at the
it.
moment, because these margin costs are based on the Bank of Canada rate for Canadian margin positions and the US Fed rate for US Fed positions. So there is a difference. So right now with Wealthsimple, because I am a generational holder, which means that I get minus 0.5% off the prime rate. So my margin interest costs in Canadian is at 4.2% right now, factoring that 25 basis cut, and 7.25% for USD holdings. So my string of thought was, okay, let's just hold some USD positions because once you hold that margin allocation, you have that borrowing cost, and then every week or month that these ETFs pay their distributions, those distributions get paid to your borrowing cost first. So it brings down your margin cost. And if you're not doing any of it, you can buy more, you pay down the margin cost, eventually it goes to zero, you keep all the proceeds, and all of these margin costs are tax deductible. So yeah, that's the stream of thought for it. So it's great for buying diversified positions. I don't do any of those risky positions where you think there's a hot stock, you borrow it, and then because you have to pay it back eventually. When it comes to
Yeah.
diversified positions, these distributions pay off your margin cost every single month, little by little bit, and then you can take out more money for for strategic rebalancing allocation when you think it's a good buying moment. So you're basically you have access to more cash than you would.
And you're using those distributions to pay down the margin cost. How
Exactly.
long do you how long would it take down to pay off the whole margin cost if you had allowed it in your brain, like, oh, you took out X amount,
Mm-hmm.
how many distribution cycles would it take for you to pay that down to zero? So you're just positive on everything.
I have a
Have you done it?
huge margin allocation that probably, let's say if you're borrowing like only $10,000 and that margin interest cost is about 7%, and assuming it's a flat NAV and it's paying you 30%, it's paying you weekly. There's some
Oh, so you're still like 23%. You technically keep 7% going on the margin.
exactly, yeah.
And then maybe a bit of that, and then the other 23% maybe you're using to
Actually,
reinvest
no.
back into
So
that.
actually minus 15% because it's non-registered.
Oh, okay.
Yeah. So it's not 30%. So it's actually 85% of that 30%. Let's just do some quick maths right now. So let's see. So assuming a 30% yield times 0.5. Yeah. So it's 25% that you
That's
are gaining off.
interesting.
But because it's all in a non-registered account, you also get a foreign tax credit on that 15% that you technically lost. So you actually deduct it for during tax season.
You're trying to do it with as low risk as possible. Highest yield,
Yeah.
lowest risk.
Yeah.
That's
Exactly.
interesting. Do a lot
So
of people do this? Do a lot
I'm
of
just
people use
testing
this?
it out.
Let's see.
Not,
What's your
I would
strategy?
say not that many people. In the US space,
Yeah,
yes, there
Eugen
are a
does,
lot.
but
Yeah.
Eugen Vasquez, he's all about margins and weekly
hmm
pays and blah 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 blah
He's
blah
more
blah.
risky though, but thing is, when it
He
comes to
is,
him,
yeah.
like if he's doing, I'm pretty sure he's doing it on like single stocks,
Y-
single stock
Yeah,
cover calls,
a lot of
which
them
means
are
that
them. Yeah,
yeah, those are definitely more risky, but also higher reward. But you have to track it you have to be on top of the game
he's way. Yeah.
because they are already because those pairs from Roundhill, there are leverage swap agreements. So they are 20% leveraged already of those single stocks, and you're
Really.
borrowing against those. And I know for a fact that I think Eugene did talked about it on the podcast with you, where during any kind of market correction, especially let's just take Liberation Day for example, you have a NAV eroding ETF of these ultra yielders. Your borrowing costs actually go up as well, but then the broker that you're borrowing against, they will actually change the margin requirement. So they will actually increase that margin requirement. So you're fighting 3 different factors here.
Yeah.
So when it comes to that, it's super high risk. You're probably not going to do well if you do those single sector allocations. So when it comes to my margin account, because I don't want to be looking at this every single day, so I only have diversified positions. So in terms of my margin account, the USD positions makes up about 10% of the entire margin account. Most of them, about 90%, are in the Canadian payers, which are relatively lower risk. Their margin requirement is also much lower. It's at 30%. So I only hold 30% margin requirements inside these holders, and I have a pretty big buffer in terms of any market correction. Like if it goes down like 40%, I would be okay, which means that I don't borrow more than, let's say, about 40 to 50% of my entire buffer that I can borrow against. It's only diversified.
That's interesting.
It's very technical. I don't want to go into too much details because beginners should not be doing this.
No, I'm just trying to think of like, I understand what you're doing. It just adds another element of risk, even though it's the likelihood and you have a buffer. I'm just thinking, do I feel like juggling that mentally? Like I always think of what do I feel like incorporating right now? Because like obviously I have margin accounts and stuff. I don't leverage margin at all. Because I'm super debt adverse. But I believe in, but I do believe in positive debt. You know, like the debt you do. Let's say you take out a mortgage, pay out a house, but then
it's kind of like taking out a mortgage if you do it smart.
If you a mortgage where you have renters helping pay down the mortgage, right? Not a mortgage
that's
you have
why. One thing you need to buy, distribution paying, monthly distribution paying, at least monthly, because that rent that you're getting pays down your margin cost. So that's the only way I'm doing it. So I'm doing the exact equivalent of saying buying a real estate property. You have monthly income coming in, which pays down your margin cost. So assuming everything goes well, because even if you buy around the property, your market value can go down as well. So you have to be super wary of the fact that everything could go wrong. But what is the most important factor is having that monthly payer, which goes towards your capital borrowing cost that goes down.
I feel like this is something I probably will start. I just have to lock in a couple things. I just like testing out different things, but with a really small amount. But I need to like lock in my cover call strategy first.
Yes,
like
you have to do that first. Yeah,
like let me get that dialed in first, and then I'm testing just writing cover calls myself, just because I want to know how it works. Because I feel like I make better investing decisions on picking ETFs if I actually understand the process better. And then when I have that locked in, then moving into this margin account thing. It's like I like to do things in steps. Like not do everything at once. Like let me get one thing figured out, then move on to the next. And then I think when I move into the margin accounts, maybe leveraging cover calls, I'll just talk to you and Eugen beforehand and be like, here's what I'm
for sure.
I'm like, honestly, that's easy. Like, here's what I'm thinking. Does this make sense? And then you guys can be like, nope, yep, try this. Okay, like that'll be the process. That's because like I have nothing against this. It just for me, I'm thinking, oh yeah, I just wouldn't be able to take this on right now because there's enough stuff on my plate.
For sure, it's something else. Yeah,
but I'm earmarking for myself like, okay, that's another strategy I can incorporate. Okay, as long as I do it the low risk way. Like
the way I'm treating, the way I'm treating this is that because I don't have a property, so I'm treating that margin as a rental property per se.
Yeah, that makes sense.
Yeah. And if I don't like the difference between an actual property and this is this margin, it's collateralized against your entire portfolio, which means that if you sell everything tomorrow, that margin is gone.
Yeah,
there's no credit. Like I could technically sell everything tomorrow and like I keep the proceeds that I've already earned because I've been doing margin for about a year and a half now.
Pay the difference on the margin.
Exactly. And you keep the rest. And there's no credit check. That's the difference. There's no credit check. There's no soft credit check. There's no hard credit check. It's just there, like extra allocation you can have if you want to. But I mean, everything is on debt anyway. So why wouldn't you? But do it.
But
you calculate the risk properly. Like don't do.
If everything goes to hell, you get margin called. It's like, hey, we have to liquidize your stock, pay back whatever you can on the margin, and then you owe them the difference. Is that how it works for a margin call?
Exactly.
the logic is also, so everything's pretty, there's not a whole lot of nuances there. It's pretty straightforward on how this works. And let's go to number 8. Did we do this? YMAX, Yieldmax Universe Fund of Options
It's
Income ETF?
exactly. So instead of just the Magnificent Seven, it's the basket of baskets. So it's like an HHIS. It's the same thing as HHIS, basically. The only difference is it's in USD. There's no leverage. I don't particularly like this position that much anymore because when it comes to Harvest, because I know you and Paul or Perry were talking about the fact that Harvest copies the best things of Yieldmax.
Oh yeah, one
Yeah.
of us was. Yeah.
Exactly. And then Yieldmax basically holds everything, even the not so great performers. So I only have this position in my margin account. Same reason, just to test it out. I'm probably gonna decrease that position just because the Yieldmax has a bunch of holdings that are not doing that well, but because of their perspectives, everything actually goes inside their entire basket. They can't pick and choose. So most, if not all, of the holdings are already inside that basket. So I don't particularly like this position that much, but I do hold it because it's actively paying down that margin cost. Same reason, but I'll probably start trimming it here and there. We'll see how that goes. But it's more diversified than the YMAX position.
What about number 9, GDV? I've never heard of this.
GDV?
Gabelli Dividend and Income Trust? I've never heard of that.
No, that's not right. It's from Brompton.
Is that even on your list?
It might can be confusing with a different ticker. GDV is on my list, but it's the TSX version. It's the Brompton Global Dividend Growth Split Corp Class A share.
That makes way more sense. Okay, it's a Brompton fund. Okay.
Yeah.
I had Gabelli something. I was like, I have no idea what that is. Okay, can you explain that to me then? Can you explain that to me?
So it's from Brompton. It's globally diversified Class A share. So it's leveraged. It's you can think of it as a leveraged ETF, but it's not really ETF because it's not borrowing in a traditional sense that way you're borrowing against a bank. Say for those 125% leverage, it's inherently leveraged in the cost in the sense that it's because when it comes to split shares, there's a Class A share and then there is a preferred share. We talked about preferred shares. They are kind of like the fixed income version where all the proceeds, all the distributions get paid to preferred shares, whereas all the different market movements, call premiums, call volatility, the differences in the market movements, that's all based on the Class A share. And it borrows against the preferred shares. So it's inherently leveraged about 30 to 35%. So I like that leverage perspective. But what the other thing is, because this position, it's about 50% focus on the US, 20% focus on Canada, and the rest of it is in the emerging markets. The emerging and all the other markets, so France, Switzerland, it's breaking down those. So it takes all the best dividend paying ETFs globally. So it's like it's like a global diversified position. If you like dividends, if you like dividend growers from a global perspective, then this could be a very good position that you can allocate to. So this position, because of the global diversification, it's a bit less volatile than the other positions. So I have this position specifically in my margin account. Same reason, diversified. It doesn't move in terms of price wise too much. It has great total returns, annualized about 12 to 13% in the last 2 years. So pretty good, pretty safe. So in my margin account, and then I also have it in my FHSA specifically, because in terms of my FHSA, I have a bit more structure, whereas because there is that 15-year time factor in place. And if I want to buy a property, say for example, later on, I want to have a position that's a bit less volatile, that moves a bit less in terms of price. So I have that safety if I want to sell it and then take the proceeds for a property.
That's interesting. I don't see a lot of people with Brompton funds either in these cover calls. Well, even though that's a good one. Let's move on to number 10 and plug away at this. We have HDIV. We talked a lot about HDIV.
Yeah.
I'm now thinking after we've been talking through, I was originally going to buy HDIV in my non-registered, but would it make sense? Doesn't HDIV have a lot of Canadian holdings in it too?
At least 60% is in Canadian.
Yeah. So that just takes HDIV. Oh, God damn it. I really like
In
HDIV
your
because that's
specific
one of my,
scenario, it's probably not recommended for your
and it's one of my
non-registered.
favorites though. It's because it's the most, it's the most stable, one of the
Mhm.
most stable ETFs you can get for covered call. It's the one that's appreciating really nicely, especially when you reinvest the dividends. I love this one overall. Like
It's great.
this is,
Price
I don't
appreciation,
even know.
price appreciation, total return wise, it's been bonkers because it has
It's a
that
good case
gold.
study.
Yeah, because it has that, I think 10%, 10 to 15% in gold producers, and gold has like shot
Yeah.
up. So because of that, it's gone
Yeah.
up along with it.
That's a shame because I like this one. Damn. Okay, well, HDIV is great. So I think HDIV is another core holdings that people can just add to their portfolio. Why do you have it as a smaller position? Just because you have all the other ones already?
Exactly. Yeah,
Yeah, you
that's the
gotta
only
eventually
reason.
pick, right? Yeah,
Hmm?
you have to pick. Like you have to pick where you're gonna put concentration
Exactly.
eventually, right?
And when it comes to the Canadian market, I like it's more boring. So I like the fact that I like to pick and choose which sectors are a bit more volatile to pick. So like in terms of it's a bit more yield driven. So you have bank, which is focused on financials, and then you have ENCL, which is focused on energy. You have youth, which is focused on utilities. All those separate sectors are paying a bit more in yield, whereas HDIV, based on this current price, it's at about 10, 11%. So definitely it's on the lower end. So it's great as a diversified holding. Specifically, it's only in my margin account for that same reason. Diversification, pay down the allocation cost, but
Yeah.
I don't need it in my other portfolio accounts at the moment.
Yeah, it makes sense in your margin. That's actually a good one for that. You have specific holdings for specific accounts when they make sense in that specific account.
Mm-hmm.
Everything is where it should be, doing what it's supposed to be doing.
Exactly.
That's good.
Good
Okay,
summary.
that's okay. Here's one that's popular on YouTube: MSTY, Yieldmax,
Yeah.
MSTR option. Why do you own this one? Same reason why everyone else does, just for high yield and.
Same reason anyone else does. I held it when strategy was blowing up. It's like, oh, okay, might as well hold it. Like the Yieldmax strategy, you know how it is. It's yield first, which means that total return comes second. When I first bought it, you would think that if strategy were to perform super well, even with that 100% capped structure, the distributions, assuming it stays afloat and it stays consistent, would be able to offset it. Like those total returns technically would be able to perform. But I've gotten to the point where it's like, oh, that may not necessarily be the case because remember, yield is based on the NAV price. And because of the fact that strategy is super volatile, like Tesla, you know what happened with Tesla. We're gonna go through that. That it's the same factor. When it comes to MSTY from Yieldmax, that price is gonna fluctuate super. It's gonna fluctuate so much, and because its upside is technically capped, you get 100% of the downside, but not the upside when the recovery is not going to be in the same position. And when it comes to total returns, that yield is going to decrease over time with that NAV if it can't recover in the same, if it doesn't have the same momentum on the recovery. So I'm not adding to that position. I bought it at its all-time highs, assuming I had assumed, like everybody else, that strategy would do super well. The inherent volatility, the implied volatility would maintain the same. But over time, because of the fact that strategy had been added to NASDAQ, there's possibilities it might be added to SP 500. Once it does that and its market value goes super high, that means its implied volatility over time is going to decrease. But what happens to implied volatility when it decreases? Volatility is going to go down, premiums are going to go down, and because the way Yieldmax has it structured, it's not going to do as well as compared to the Harvest strategy position, which I'm adding a bit more like on and off here and there. So when it comes to the Yieldmax strategies, the only ones I would be only adding to would be the YMAX position and the YMAX position. Everything else, I'm in the negative when it comes to total returns wise. So I'm just gonna let it do its thing, let it pay what it's gonna pay, let it. I'm not gonna add to it. I'm not gonna sell it because technically it's down and it's in my TFSA. It's only in my registered accounts. So my TFSA and my RSP. So once I break even, or I might just leave it as it is because it's such a small allocation in my portfolio. Like I said, like once you add more money to other positions, this allocation is going to go down, which means that I might just leave it as it is, you know, because it's still paying.
Yeah.
As long as it still pays and I break even, I get all that house money back, that house money status, which is when you get all of the you get all the money that you invested in a position back. So you break even and you get more.
Yeah.
As long as it keeps paying, who cares? It's going to do its thing. Like even if it goes to zero, as long as I get all my money back and some more, like it's going to do its thing. Yeah.
Yeah. Fair enough. Yeah. Fair enough.
But I probably
I
don't think I won't recommend this position to anybody. It's yeah.
Yeah, I don't think most people do anyways. Number 12 is QQTE, Roundhill Nasdaq 100.
QDTE.
QDTE, thanks. Oh yeah, I should know that too. Never mind. Sorry, QDTE.
Mm-hmm.
I think this is another one that Eugen owns. That's why I know about. I know about all Roundhill ones. I know because of him, to be honest. Is the other one held in your margin?
Yes, only in my margin account. Same reasoning. It's on the 0 DTE structure. I know Roundhill, I bought it originally as a test, to start as a test like pre-liberation. So it had gone down pretty significantly, prior to after Liberation Day. So I held that position throughout, but it's been such a good payer and it's only in my margin position, which if I wanted to, I could capitalize on the losses and claim it against all the capital gains if I want to. But based on the fact that I'm actually pretty positive total returns wise, like it has done pretty well based on the fact because it's already diversified as it is. It's on the NASDAQ 100. It's doing 0 DTE calls, which means that and based on its structure, it's their cover call writing strategy on the NASDAQ is that there is overnight exposure. So their call writing is only during the market hours. It's similar to TALP Alpha. TALP Alpha does it better with TDAQ. We'll go through that as well later. But based on the fact that it has overnight exposure, which means that there's more upside potential because all of the overnight movements it's uncapped. Their call writing, there's it's true 0 day to expiry. So their calls are only during the market day, which means that there is more upside potential. And
the rest
exactly, and post Liberation Day, like if you look at the total returns wise, it is actually catching up again. It hasn't because based on that one day, how the volatility spiked like 9%. Like it's every cover call ETF's nightmare, just because like who's gonna predict that 9% movement in one day? You get like 9%, like if you're lucky enough, you get 9% a whole year. 9% movement one day, it's any cover call's nightmare. So past that, like it has recovered pretty well. So I've just been averaging down slightly, little bit, you know, so on and so forth. So yeah.
All right, so now we have number QQL Global X.
QQQL, yeah.
One. Yeah, QQQL. Yeah. Talk us through that one.
It's a 25% leverage on QQC, so Invesco. So no covered calls, pure growth, and it's entirely in my RSP position. So based on this position as actually pure growth, there's no dividends paid. There's no distributions. Based on the fact that in my RSP, I'm not pulling it out. So I have a mix of different strategies in my RSP just because of the long-term holds. I'm not touching it in like 30, 35 years. So I can test it out. I can do whatever I want with it. You can even pull out the proceeds anyways without paying like massive fees, just prefer pulling out like prior to like 60 years old. So just testing out different strategies with all the US listed positions. This is the only Canadian listed position I do have, and it's pure growth. it's like 25% leverage on NASDAQ, you know, the track, like the long-term track performance of QQQ. So it's just a little bit of leverage on that. And theoretically speaking, it will do very well long-term. So it's my only growth position.
The next one you have is SDAY. Are you going to build this up? SDAY from Hamilton?
SDAY is in my non-registered account that I'm trying to build a case study position on. So I posted
Okay.
on Blossom because Paul Santori, he's doing he's actually he's building a case study of whether or not he can pull dividends at pull distributions every month to live on, and whether or not it's sustainable long term. So I was like, oh, I don't need any of these distributions. Why don't I have a separate non-registered account, kind of simulate a case study where I get to pull. So my entire this test case study position is about $35,000, and I was like, since Paul was gonna pull about $1,000 on his $60,000 non-registered position, I was like, okay, I don't want to have too much just money sitting around in a non-registered account, but I want to have enough that's still significant. So I have mine at $35,000. And I had a poll done on Blossom about a month ago where I was like, oh, which 10-year period of a person's life do you want to see that can basically mimic the different kinds of expenses a person could have, whether they want to pull distributions in their 20s or 30s or 40s or 50s or 60s, so on and so forth. And the most popular one so far that I did for this first test, I'll test it out for like a couple of months. So as a 30-year-old, what kind of expenses that this 30-year-old might want to pull out of the non-registered account? Let's say estimated between $150 to like $500 per month, whether that's sustainable, have it be consistent. So in this, let's just say 8-month case study period, averaged out distributions that it can pull every month, and then see whether or not it's sustainable and it can stay at that $35,000 month every month. And those distributions that I pull out, I don't technically pull it out. I just move it to my margin account. And then after 8 months, we'll switch to a new persona and then redo the voting and see. And then
that you're switching out personas. I
exactly.
like that.
I haven't started it yet because I want to showcase this on the YouTube.
Yeah, that's a really good YouTube series. I wouldn't do that on mine because mine is just like build and set it forever. So I'm doing a case study, but my case study is like, what would I do, Gary, specifically for myself? I don't I'm not here to do a persona. It's like, no. This still has to somehow work into my life. Sorry, guys, you can watch. But like, how do I? And I think I'm working with like $100,000. That's where mine is. So
I'm just doing a small version, like
I like
cater to everybody basically. And then switch it up.
No, yours is way more optimized for YouTube as well. I would watch that 100%.
Okay.
Like, oh, that isn't. I'm curious. Like because I'm only optimizing mine for myself, specifically for my income, like everything, like right away, like HDIV and all their awesome ones are like off the table, which I would recommend to other people. I would recommend a lot of these.
So I have a five-way holding 5-way split in that non-registered account currently. So divided 5 ways. So I have SDAY in there. I have CDAY in there. I have UTES. So that UTE position is just for that non-registered account. And I have a little bit of MSTE for that yield boost, slightly yield boost. That's actually lower. That's lower weighted compared to the rest of the positions, just because it's super highly volatile. So I don't want to put too much of it. So it's about a 23% allocation and like 5% allocation of MSTE. And then the last one is HHIS. So it's all pretty much diversified just to see whether this would be stable long term. So yeah.
The only rationale I would add, I can think of myself adding bank UTES into my portfolio because I did really want them. And HDIV is because it is valuable information for me to report on for most people. Most people aren't making just realistically, they're not in the highest income bracket.
Right.
So my line of thinking, like, I don't mind taking a little bit of a dividend hit on my taxes if I can create at least somewhat relatable portfolio structure in my non-reg. So I might still buy bank UTES and HDIV. It just, they might not have the same size allocation in my portfolio as they may once have. I might still go all the way with Big Y and all those other ones because
Try it out. This is a test,
yeah.
anyways.
But I probably might be a little bit more cognizant of YouTube as well and giving people some value. So SDAY, that's that. We talked a lot about that. Here's what I'm interested in is these Bitcoin ones. I talked to some people about Bitcoin, and I still don't. I understand it. I still don't quite see the value though. But I spent a lot of time and energy talking to experts on it. I still don't quite understand the value, which doesn't make me a big investor in it. I sold off a lot of my MSTE position. I sold off a lot.
Oh, okay.
I sold off because I was in the negative. It bounced back and then actually became positive on the position.
Oh, nice.
And it was like half of my cover call portfolio. I was like, this is ridiculous. I'm like, I need to get this down to 10. I need this to get to 10%, like a normal skew. So I basically sold off like $50,000 worth. Wow. And now I have like 10, because it's $100,000 portfolio. So I have like 10 grand in MSTE now. And it was purely based off of like, I don't know enough about Bitcoin. I know a lot about Bitcoin, but I still don't. My old man brain is not understanding the value. I understand Bitcoin. I just don't see the value properly in it. And then secondly, it was overweighted in my cover call portfolio. It was simple as that. It's like, I was fine with everything about it. I was fine with the volatility. I was fine with everything. Everything made sense. It was all cool. I was just like, oh, I should be using this for a more balanced approach.
If you're a bit more conservative, you probably want to buy Bitcoin itself and not strategy, because strategy is already leveraged Bitcoin. And right now, if you look at the different, like the price difference between strategy and Bitcoin is technically overvalued compared to where Bitcoin is. So it's already leveraged on Bitcoin. And then it's a cover call leverage position, MST, on strategy. So you're doing leverage on leverage. So
I'm going to be owning the coins itself.
It's a good decision to trim it.
Yeah, I'm actually going straight into. I'm doing a whole other thing that I'm working on is like understanding, like actually owning the coins themselves, owning Ethereum, owning Bitcoin, and all, like just like going to the root. So HBTE, Harvest Bitcoin Leaders Enhanced Income ETF. Explain both of these together, HBTE and MSTE. What are the differences between them, and how they're set up? Because all I see is Bitcoin when I see both. Harvest Bitcoin Leaders Income Enhanced, that's HBTE, and MSTE, Harvest MicroStrategy. MicroStrategy is covering MicroStrategy, the company, but Bitcoin is just covering Bitcoin, the actual currency. That's the only difference.
So strategy is strategy is, you can kind of think of it as a treasury company on Bitcoin. So you're doing it's like a leverage position on the Bitcoin price. I mean, all of these, you're not actually owning Bitcoin. They're just tracking the price of Bitcoin. Like if you actually want to own Bitcoins, then you need a separate coin wallet, which is, you can own it on Wealthsimple, you can own it on Coinbase, you can own it on any other kind of coin, but it's a separate wallet in order to actually buy Bitcoins. It's its own headache. I want to deal with that. Like, I just want positions like ETFs that track the price of Bitcoin or have like leverage positions on Bitcoin. So when it comes to MSTE, it's like a leverage version of Bitcoin, and you have that cover call position. So it's like leverage on strategy on Bitcoin. So it's purely a leverage position on Bitcoin. Where for HBTE though, I'm just looking down the list of, so when it comes the Bitcoin leaders, it's all the Bitcoin miners that have allocation or like specific allocation in Bitcoin. So it's not just strategy. Strategy is part of that list, but you also have you also have I don't know all of it, but you have Coinbase in there, you have Robinhood in there, you have the Bitcoin miners, and then you have the Bitcoin treasury companies, and then there's about 15 to 20 different companies that are all related to Bitcoin in some way. So it's more diversified. So it's not just strategy. Strategy is part of that list, but it's everything else in there that's related to Bitcoin. So it's a bit more safe.
I get it. Now because a lot of people buy this in a bucket now. They buy HBTE, MSTE, and then there's a third one from Harvest, and they buy all three because it gives them
HBIX.
Because it gives you various exposure to the Bitcoin market in different concentrations. That's why probably Harvest built it that way. I'm assuming.
Exactly. So HBIX is cover calls and leverage on Bitcoin specifically, like the Bitcoin ETF.
I think that's what I was thinking before. When I was
MSTE is
MicroStrategy.
Exactly. And then
Yeah.
HBTE is all the Bitcoin miners and
and
treasury
treasuries.
companies. Exactly.
Yeah.
So I'm just looking at the list right now. They have HBTE spiked crazily in the last week, but right now they're top 10 holdings. So they have 15 positions in HBTE right now. They have IREN, they have Block, they have Coinbase, they have Strategy, they have Mara, they have Riot Platforms, Galaxy Digital, Core Scientific, TerraWolf, and they have Hut 8, Cypher, BitDeer, CleanSpark, and some other company, but there's 15 positions all related to Bitcoin. And Strategy makes up about 10 to 15% of HBTE. So you don't necessarily need both MSTE and HBTE, but I would say HBTE is definitely more diversified, so it's a bit safer.
Yeah.
So I would actually personally speaking, I'm actually adding more to HBTE just because of the fact that it's not just Strategy. The Strategy is always clearly not the only Bitcoin treasury company out there, but it's already leveraged. You're kind of double leveraging. So I'd rather have a bit more a bit more diversified position. So I'm actually actively adding more to HBTE than MSTE. The only reason I'm adding MSTE right now is because it's lower than my cost base. So I'm just averaging down until I break even.
The next one you have is CONY.
Mm-hmm.
Is that another one you have in your margin account? Because that's US listed?
So with that thinking, I bought CONY in the same line
talk
of
us
reasoning.
through what CONY is first. So
it's the Yieldmax Coinbase position.
Yeah.
Yeah. So it was originally the same line of reasoning as MSTY. So the Yieldmax MSTY position, you would think that, those very high yields would be able to, even with those really high yields, you would get NAV depreciation, but you would still have super nice total returns long term. But the problem with CONY specifically, it went through a huge correction during the crypto winter, which means that there's a huge correction of the Bitcoin price, which means that since Coinbase is the wallet of Bitcoin, it's going to go down with it. And once it went down, you'll notice that stock price wise, even though Coinbase technically is doing well again, CONY is not. I don't know what happened. It's not doing as well as it should have been, which means that there might be something wrong with the inherent strategy within the underlying, which kind of makes sense because when it comes to Yieldmax, again, it's 100% capped on the upside. It's heavily focused on the distribution. But if you have a stock price that declined like 80% from its top, that yield is also going to go down with it, right? Because yield volatility is based on the NAV. If you have a NAV and stock price that went down like 80%, that yield is going to go with it. So it's like a double whammy in a sense. So I was just talking a little bit about this in our PII Discord group that Adriano has. And we did talk about the fact that it's also called yield erosion in a sense, that your yield is also going down with your NAV. So it's NAV erosion plus yield erosion.
That's brutal.
Yeah. So that CONY position, I'm just waiting for it to eventually, I'm treating it as same as my MSTY position, break even, keep paying. Exactly. Well, it's not going to go to zero because Coinbase will technically never go to zero, but most likely it's going to reverse split. So every time, if the stock price keeps declining, it's going to reverse split. It might decline again, reverse split, decline again, reverse split. So I'm not going to add to its position. I'm just going to let it pay what it's going to pay, what it's going to be worth. But it's just where it's at. So yeah, not going to add to it. Not going to sell it. So we'll just see how it goes. It's only in my TFSA. So yeah, can't really, it's a huge loss right now, but yeah.
It's fine. It's fine. You're doing okay. You're doing just fine. Yeah, it's okay. I don't feel sorry for you. That's what I'm saying. I feel you're okay. Number 17 is UTES. And now it knows UTES, Evolve, Canadian Utilities, Enhance. I think I'm going to buy these regardless of my tax situation. Great. Yeah, I can't. It's just, I actually like them too much to not. And I want to talk about them more because I do like them, that I'm just going to buy them. I have a hard time talking about things if I don't own it. So I need to own it. That makes sense. If I believe in it, I own it. Utilities, Canadian utilities. I think this is pretty straightforward.
Yeah.
Just covered calls on Canadian utilities.
That's it.
It's
Yeah.
as good as it gets. It's utilities, same way bank is banks. I'm gonna blast through that just because it's so straightforward and it's another core position.
Yeah.
I wanna after the next one.
Mhm.
Let's get through the list and then I wanna talk to you about how I'm gonna set up my portfolio. Okay.
Sure.
And I want to hear because now we've been talking about this. I'm gonna go a little bit faster now. Because I want to talk to you about my portfolio setup. Do not worry about the tax situation because I want to purchase some of these because I want to talk about them on YouTube and I do believe in these companies.
Mhm.
So I don't give a shit. It's fine. Let's break that down. So let's keep moving. The next one is CDAY, which I originally was not going to buy,
Mhm.
but I think I'm going to buy it because I want to own all three. Just because I just want them, just like Pokemon, I want to collect them all type of
Right.
thing. So CDAY, Hamilton, YMAX, same thing. It's
Yeah.
writing. What's the 20% is writing cover calls on VOO?
VOO. Yeah.
Yeah. And then the other one is just enhancing Canadian dividend, high paying dividend companies or something.
It's the same as VDY basically.
Yeah. Okay.
You can think of
that's
it as VDY plus a little bit of leverage and zero DTE exposure to the S&P 500. At the underlying.
Do you
is
know off the
basically
top of your
same.
how's the capital appreciation and how's the I don't know, this is a weird way to say it. The NAV been on CDAY, SDAY, QDAY since they've launched? I haven't really looked at that. Have they been okay?
QDAY has been up 20% because tech has been
that's because
of tech. Yeah. CDAY has been because of the gold producers in CDAY CMBV allocation. CDAY has been up price wise about 10%, whereas SDAY it's pretty flat. It's actually slightly negative. So I'm actually allocating a bit more to SDAY just because of it's lower than my cost base.
What does SDAY hold?
SDAY is SMVP, which is the U.S. Dividend Aristocrats.
Say that last bit again.
The U.S. Dividend Aristocrats.
Okay, so what companies are those?
3M, Coca-Cola, Pepsi,
all the ones.
Exactly, yeah.
Basically all the ones that Warren Buffett likes. Stable,
exactly, yeah.
dividend.
I can look at the list.
Okay, so they're all more or less reflective of their underlying assets.
Yeah,
there's
exactly.
Nothing. That's basically the question I had. It's like there's nothing wonky happening, nothing weird. They're
okay.
Performing.
Here's the list. So there's 3M, there's Walmart, there's McDonald's, there's Colgate, there's Eli Lilly, there's NextEra Energy, ExxonMobil, Caterpillar, Hershey's, Procter & Gamble.
Okay, so they're all. So now, here's how I feel about SDAY, QDAY, and CDAY. I feel like they're lower risk because they're only writing cover calls on 20%, which is VOO or whatever they're doing. The other all you're doing with the other 80% is you're just owning dividend stocks, which is the most boring.
It's the most boring.
And they're all established ones. Like it's like their list of they all have stable, slow growth. Right, like just like it's not crazy. You're probably not going to beat the S&P 500 or whatever, but it's just like this.
Yeah.
And then it's just that 20% cover call to boost the income. So it's like technically there's not enough data. These could prove as technically
it's less
core
volatile than the S&P, but I'm not. It's not going to outperform because there's no tech exposure.
But if for a guy like me who wants to have a long-term hold and never sell, these are good candidates because they'll never do anything crazy right at the sell.
Exactly.
It's like they'll just slowly increase. I can keep buying back shares over and over and over again to capture growth just by buying more into it.
Yeah.
But
it's even then it's probably at a slower growth because it's only 10 companies that are dividend payers. So I'm actually looking at the holdings. So it's only 10 companies in SMVP. So you're missing that other 490 positions of the actual S&P. So it's stable, it's boring. There's going to be some price appreciation, but you're just buying it for the income for the most part.
I wonder if everything reinvested back, what the growth would be on that. Would it be like a 10%, do you think, return? Like a 10% year over year growth if you invested everything back in? I would assume 10%.
10% give or take, yeah. Probably.
Right, and then like S&P would be like
12%
or something.
Yeah. That's why I only have SDAY in my non-registered account for the case study, but I'll actually hold it in my TFSA,
Uh-huh.
but I am actively considering QDAY, which is pure tech exposure, because it holds all of the actual companies that are listed as tech specifically. So no Coinbase, no Palantir, no. So you have the semiconductors that are in there. So you have NVIDIA, but there's no Coinbase, no Palantir, no Strategy, no no Tesla, no Google or Microsoft. None of them are actually in there. So I feel like QDAY would be a great complement to either HHIS and BIGY. So I'm actively looking at it, but QDAY is like on a roll. So I'm just like, I'm not adding to it right now. I'm waiting for a possible correction in order to add it to it, but I won't be adding SDAY or CDAY. For me, in my TFSA specifically. Nothing is bad. It's great, but like I won't be adding to it in my personal experience, in my own personal allocation.
The next two we'll just talk about together is TDAQ, the Yieldmax TQQ options, and NVDY, the Yieldmax whatever.
NVIDIA. Yieldmax on NVIDIA.
Yeah. So that's just NVIDIA single stock is writing cover calls on that. So that's pretty straightforward. That's NVDY. TDAQ, Yieldmax TQQ, that's just on
that's not Yieldmax. It's Tap Alpha.
There you go. Correct.
Because remember,
but it is TDAQ, right?
It's TDAQ, TDAQ.
So what is that on the NASDAQ 100?
It's on the NASDAQ. So I don't know if anybody was talking, any of the previous, I think Paul was talking about it, where it's on Top Alpha, which is which they had TSPY, which is these zero TTE.
Yeah.
Yep. So TDAQ is basically the same strategy, zero TTE call options on the QQQ. So because of the track record of TSPY, it's only in my RSP. I wanted NASDAQ exposure 0 TD position, so that's why I added a small position in TDAQ. But it's only released since a week and a half ago, so there's no long-term track record. So I just started a position in it pretty recently.
The next one I really want to talk about, so I'm just gonna move right to this one, is BLOX from Nicholas Funds. I get asked about this a lot.
Yeah.
I haven't done a whole lot of research. I've been talked about. Talk me through BLOX. Explain what it is. This is obviously US listed, right?
Yes.
BLOX. Just talk me through
it's
it.
It's basically we went through HBTE. It's the US equivalent of it, basically. Oh, okay. Yeah. Same thing. Bitcoin miners, Bitcoin leaders, but then there's also a allocation to Ethereum. So they also have Ethereum exposure. That's the only difference. So you can really pick and choose if you want. If you want Canadian listed, you would get HBTE. You want US listed, you would get BLOX. That's so it's really just if you want.
So if you have a preference for US listed, this is where you go.
Exactly. Yeah. Plus, if you want Ethereum price exposure,
and Ethereum.
Yeah. HBTE does not. It's just focused on Bitcoin.
Yeah. So I'd probably leave BLOX then. Just for my personal preference. Okay, here's a big one. Whatever number we're at. BIGY. Evolve ETF. Okay, this is a big one. Talk me through this. I'm talking to the CEO pretty soon here. Talk me through BIGY. Educate me so I know what to ask this guy.
I mean, it was just released about a week ago. From what we do know, it's like a higher income version, more income focused than HHIS. So, and it's a bit more concentrated. So, whereas HHIS has 15 holdings, BIGY more concentrated. There's no Eli Lilly, there's no Costco, there's no Netflix. So the current positions of BIGY is Max 7 plus Palantir, Coinbase, and Strategy. So even more concentrated in HHIS, which means that
10% in each, right? They're equal 10%, weighted.
Equal weighted, exactly. So, and they're doing about 50% call writing, so a bit more concentrated. They have a bit higher leverage. So HJS is 25%, BIGY is 33%. Right? And the other difference is BIGY is Canadian dollar hedged. They will be coming out with an unhedged version, BIGY.B, and a US dollar version, BIGY.U. I'm actually actively looking at the BIGY.U position because I will probably most likely be swapping my YMAX and my other USD positions, looking into swapping to BIGY.U so I can avoid that 15% withholding tax that you don't get back in your TFSA. I mean, Perry did say that 15, like you can, even with these higher like dividend yielders, that 15% you do pay up front, you still get the rest of it, and there's no other taxes. But I'm a bit more focused on total returns. 15% still is pretty significant total returns wise. So as soon as BIGY.U does get released, I'm going to switch it over because make it easier to deal with.
Well, the 15% is on dividends, though.
Yes.
Yeah, a lot of this doesn't come in dividends, though, does it? It comes in return of capital.
No, the entire thing. So distributions.
So 15% on the entire?
On the entire distribution, yes.
Is this yield accurate that I have here? I think it's wrong that I have here. It says 45%, highly variable. Is that accurate for BIGY?
That's that its current yield should be sitting around it hasn't even paid a distribution yet because it was just released. So their target is starting yield is about the 30% range.
Really? I'm gonna write that down. And that is every 2 weeks or twice a month, I should say.
Right? Twice a month, yeah. So semi-monthly.
I haven't bought it yet, and I should have probably bought it a little bit when it first came out because the price immediately went up. Like, I think it's, yeah, I was like, God damn it.
I mean, it's going to go back down.
Yeah, it will. I'll eventually get it. So, okay, that's another position I might add to mine. And the next one is CANY. Evolve.
CANY. Same thing, has 10 holdings in, it's basically HHIC, which is the Harvest version. It's a slightly higher leverage, it's 33% compared to 25%. But the same position, you have Chemical, you have Shopify, you have Royal Bank, you have CNQ, you have all the, the high liquid positions. You have the national, I think you have Bank of Nova Scotia in there. So
they're basically just like, okay, Harvest, you did HHIS and HHIC. We're going to do a slightly more leveraged, slightly more income generating, slightly more concentrated version of what you're doing. Is that essentially just what happened?
Yeah, exactly.
Okay, so then the next one is TSLY, Yieldmax, that's Tesla.
Yeah. So it's a whole spiel. That was my first Yieldmax holding. So back in 2023, still figuring out. I would definitely say yield chasing because, oh my God, options on Tesla, it was like 70, 80%. It was crazy. It was amazing. But then Tesla went through all those things and it's done okay. I'm actually finally positive on it after holding it for 2 years. So one, finally positive because it went through its whole thing. It reverse split like twice. So never added to it, never sold it, held it for 2 years. And I'm finally positive on it, which means that I will finally get rid of it because it's actually in this one, I actually added, it's in my FHSA. So it's not in my TFSA, but same consequences. So I will actually be trimming because I have NVDY and TSLY in my US FHSA, which means that as soon as I'm still same reasoning, as soon as BIGY.U gets released, I'm gonna swap all those to that to avoid that 50% because I'm still paying that 15% withholding tax on all distributions collected.
The next one is XYZ, Yieldmax XYZ. Let's explain.
It's on block. So Yieldmax call options on block. You can think of it as it's very similar to strategy, except for the fact that it hasn't recovered. It's in the same ballpark as strategy XYZ. So this position, I added a little bit to it because I thought I wanted like a slight diversified because all of this was added prior to when BLOX or HBTE was released. I bought it like a year ago when it first came out. Just the test position, you can see it's like 0.1% of my portfolio. I just bought it as like a test position. It hasn't not done very well. Same reasoning. It's on Yieldmax. So I'm just gonna leave it as it is. If I ever break even, let's say, I'm actually okay total return wise. Price wise, it's gone down like 55%. Yeah. Total return wise, negative 41%, which is about a negative $900 even after all of the distributions collected. So I'm kind of debating whether I just want to sell it and get rid of it because it's like a $1,000 position. Yeah.
Yeah, and you're staring at it all day. So, yeah, that's one of
I'm probably
those.
just gonna sell it off because
Mhm.
it's just one other position I really don't want to look at, and because it's so little. Same reasoning. I'm probably just gonna wait until BIGY.U gets released. All of that, just gonna go fund and walk right in there once it gets released.
HYLD-U, that's next one, the
Mm-hmm.
US listed version
The US
of
listed version of HVOL, you already covered it. It's the same thing.
Yep. And then I'm gonna end with another one, but I'm gonna say this first is WPay is a newer one you just bought from
Mm-hmm.
Roundhill.
Yeah, this morning.
Talk us through that a little bit.
So it's the fund of funds. It's like the same as YMAX, except it's for all the ones from Roundhill. So it's like a weekly pay. It goes through a cycle that Yieldmax does. So it's top holdings. There's about I think there's 12 positions. So there's Apple in there. There is NVDY in there. Okay, so it's a Max 7 plus AMD, Berkshire Hathaway, Netflix, Robinhood. I missed Meta because that was the other one. And then there's Avgo, AVGO, Palantir, and
Yeah.
Coinbase and MSTR. So the difference with this WPay and Yieldmax is that it's not covered calls, so it's swaps. So there's swap
Swaps.
agreements. So it's leveraged swap agreements. So you can kind of think of it as it's a leveraged version of the single stocks, 20% leverage of the single stocks, and it's uncapped. So all the downside, all the upside magnified 20%, and it's paid weekly. So my reasoning is, okay, I can kind of think of it as a good alternative to YMAX, because YMAX has not been performing very well. It's based on their cover call writing strategy, 100% capped, which I don't like. So I heard great things about this so far. We'll see how it goes. I do not want to own any of the underlyings because any sort of market movement, it's going to move 120% each way. So my reasoning is I want to be a bit more hands off. So let's just buy the basket, all of them, and see how that goes. So I just added a 0.1% position, like $1,500 in my RRSP specifically, and just test it out for like a month or so and see how it goes. If I don't like it,
Yeah, fair
I'm
enough.
going to sell it. If I do like it, I'll start adding more to it and trimming my YMAX position and add it to that instead.
Yeah, fair enough. Last one, the most popular
ULTY.
one on ULTY. All I see is you want to make a video about ULTY and get 100,000 views? That's what you do. That's basically
Breakdown
put ULTY
ULTY?
in your
Okay.
break down ULTY in your title, put it on your thumbnail, you'll get 100,000 views. It's the most popular one. You bought it because ULTY. I think you kind of talked about it earlier too, though.
Yeah. I bought it when
Yeah.
it first released at $20. You can look at its stock price at about $5.80 ish, give or take. It's been fluctuating here and there. Bought it when it was original strategy, when it was doing swap agreements, so not actually holding the underlying. So they're doing constant readjustments of buying the heaviest volatile holdings that you can think of, that most of them we don't even know what they were. So that was that. You don't like, when it comes to these positions, you still need to know what you're owning. You need to know the core technicals and fundamentals of what you're owning. Finally, when they switch to weekly, when they finally switch to actually owning the underlying, you have some of the more like knowable, you have strategy in there now, you have Coinbase, you have Palantir, you have Circle, you have Robinhood, all of them like names that you actually know and can recognize, and it finally performed better. But still, this position, because it's in the title, ultra income, and it's yield first, 100% capped, yield first position, which means that if you're going to buy it, think of it as an alternative to gambling. At least you get some money back. It's purely just gambling money. Do not put too much money in this. I have like 1%
Everyone
allocation.
who says it, by the way, always references gambling. Anyone who buys
it's purely gambling money. You don't even know, like, I don't even know there's a long-term track record of where it's going to go, but it's going to most likely reverse split multiple times.
Okay.
But yeah, not much more you can say about it.
Those are your 29 holdings, giving you estimated $18,750 Canadian a month, $225,000 a year. Portfolio size 965. Now I want to quickly say, what am I going to pick? Because you basically own everything that I would potentially own.
Okay.
right? So
Yeah.
it's there. It's all there. Nothing outside of your box will I be looking outside of because you own everything. So you own a little bit of everything. So I'm going to make a number. So there's USCL, QQCL,
Definitely the top
Bank.
holdings for sure to consider.
I'm probably going to have all of your top ones. So where we at? Bank is 3, HHIS is 4, HYLD is 5,
Mm-hmm.
ENCL is 6. Let's go down to, I'm going to keep MSTE because I like it. I don't think you don't have MSTE. Yeah, you do. Yeah.
I do. About a
MSTE,
1% allocation now.
SDAY, I'll get. BIGY,
Mm-hmm.
I'll get. UTES, I'll get. CDAY, I'll get. That's 12 positions I will have in my, yeah, that's 12 positions.
Did you talk
So
about
I'm
BIGY?
thinking, yeah, I think I've added BIGY. So with BIGY, that's 12. So that would
Okay.
be my portfolio is USCL, QQCL, Bank, HHIS, HYLD, ENCL, SDAY, QDAY, CDAY, MSTE, BIGY, UTES, and that's it, right? Yeah, that's
Yeah,
it. So
that's it.
that's
Yeah,
I'm pretty
that's
sure that's 12.
12.
So I think
What about
for the
QDay?
sake of, yeah, and Q day, all the days.
Okay.
So I think that's 12,
Yeah.
roughly. So we're going, if it's 12 or 13, I'm thinking about doing this then. Cutting down my HHIS position even more to just 10K
Okay.
and doing 10%, 10K, 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 10K across 12 of these funds.
Okay.
They all have exactly the same equal weighting. And that is my starting point.
Okay.
And then over the next 5 years, I just lean more into other ones because it's just everything is average weighted out at that point. I just have 12 divided by 120K, so $10,000 in each across 12 of
Mm-hmm.
these. My risk is greatly reduced. Everything is reduced, and then I basically just build. And as I move along in my cover call experience,
Mm-hmm.
I start figuring out which ones I like more than other ones, just how they feel, and I pivot more distributions into the ones I like.
Yeah.
I buy some that are more undervalued, and so those 10%, that equal weighting of like 8% in each or whatever, will eventually shift into different weightings after a year. Everything will be all different, right?
Mm-hmm. Yeah.
I think that's the best way for me to do it. Just it's the easiest to report on. Everything starts at the equal weight, and then I don't know, slowly change the distributions and the weight. Or would you lean heavier into one more than the other?
I would say when it comes to MSTE, I would probably swap it for HBTE because I prefer
yeah.
having more crypto miners and treasury companies than just relying purely on strategy
You're right.
because it's not a one-on-one line between strategy and Bitcoin. So that would probably be the only change I would make. And having a equal allocation throughout all of them, that's a good strategy. When it comes to whether or not you want to, I think that's a good starting point.
I'm not
And
maximizing yield. I don't care.
yeah,
I just want to have, and I'm only buying things I can hold for as long as I potentially could hold these for.
okay,
And I don't even know which ones I like the most yet. So I feel like at $10,000 or at $10,000 each, like none of them are ever going to go below that anyways.
right,
So I'm just starting them the same. It's which one am I going to build the more? I'm
hmm
just giving them all the same starting point.
yeah,
And I'm not chasing monthly. I don't care how much I get paid monthly off of these. I could care less. I'm looking for stability and what could I stay for the long term. And if I don't like something, at least I don't have to sell off $50,000 of it like I did with MST this time. I can just be
hmm
like, oh, I only have a $10,000 allocation. I can just swap it out and
yeah,
swap it in for something else. It's a little bit easier to swap things in and out if I don't like it. Um, I don't know. What do you think about that though? So I'll do what you said, MST swap with HBTE, have all of those, even though they're not the most tax efficient. I don't care. I just want them. I want to talk about them.
hmm yeah,
I like
that's
them. I like
great.
the company. So it's like, whatever. That's a good enough reason for me. That makes up the difference. That's the portfolio. I think that's what you'll be seeing in the next couple of months from me, I think.
Yeah, that works. And the only thing I would say that because HBTE is crypto and then ENCL is oil and then utilities is UTES. So those three satellite or whatever like non-diversified positions, you would probably only want to add to them if they're lower than your cost base. So just look at
Yeah.
that. Everything else, because that's diversified, USCL, QQCL, QDAY, SDAY, CDAY, HYLD. Are you adding HDIV? You're
No,
not,
I was
right?
gonna, but then I
No,
feel like
no point. There's no point. You don't need to
after
add it
all of
as
this,
well.
I have so much exposure to everything that HTF
Yeah.
has. Like, why would I? It's
I would
yeah,
add banks to that. So USCL, QQCL, HHIS, BIGY. Actually,
bank utes.
BIGY, I would probably only add, because of the fact that it's more income focused and less price appreciation. You probably wouldn't even get that much price appreciation, but probably only add it when it's lower than your price, than your adjusted
Y-
price.
Yeah,
And
yeah.
then maybe the same thing with HHIS. Not sure yet, but you can be looking at that. So I would fit HHIS, BIGY, UTES, ENCL, and HBTE. Those 5 positions, you would probably do strategic rebalancing and rebuying. Look more specifically at the price. When it comes to USCL, QQCL, HYLD, SDAY, QDTE, and CDAY, and bank, those positions you can buy and reallocate whenever you want because they're already like super diversified. So yeah,
I think that's
whatever
the
fits your
strategy.
needs.
I think we figured it out. That's it. I figured it out with you. It only took me 3.5 hours.
It's a good starting point, and then you trim
It
and fit
is.
as you want, right?
Man, if a lot of people watch the whole podcast all the way through, like my retention metrics, whoever made it through the end of this, holy crap, do they know a lot about cover call ETFs? I learned so much, especially with the tax side of stuff and like the ins and outs of this. I feel way smarter coming out of this than I did going in. So this is good. This is very, very good.
Glad to be very
You're also launching your new YouTube channel.
Yes.
What's your timeline for that? Like, when are you going to start getting content up? I'm just trying to, so people
So
know.
right now it's just to put a name out. Like I added a posting to both your Discord, another Discord, 3 Discord channels that I'm actually the moderator of. So there's that. So added that to that. And then I also added it to Blossom. So I was trying to build a following there. And now I'm actually working on an introduction video as we speak. So probably script it, film it, maybe, I don't know, do you think maximum like 5 minutes? It's just to have it on the homepage.
Yeah, to me, it doesn't even make a difference. You don't even need intro videos for your homepage. You just need the most
I think it's a
recent
nice
video.
to have, just something to click on.
It's a personal touch for yourself, for
Right.
sure. But your first video should be breaking down your entire portfolio.
Okay.
Just walking through it and labeling it my
Even like all
225.
sit it down in one, so have like an hour-long video, or break it down in 2 parts.
One long ass video.
One long
It'll
ass
work
video.
better for retention. Yeah, because people will either watch 0 seconds of it or they'll watch the entire hour. So then YouTube will be like, oh, you have an average watch time of 30 minutes? That's crazy. We're going to push this out. But if you have like a 5-minute video, someone watched it for 0 seconds, watches for 5 minutes. Oh, you have an average watch time of 2.5 minutes. 2.5 minute or the 30-minute watch time. They want the 30-minute watch time. Average watch time, because they can show more ads, so it'll push it harder. That's just marketing Gary telling you.
Okay.
And then a lot of value. People sit down and you just open up your PDF. Like, I'm looking at your PDF that you have of me, and you just walk through your PDF and be like, look what Perry did. He's like, here's
2 hours of just 2 hours just as Excel spreadsheet.
Yeah. Yeah, that's all people.
It's crazy, and he only started YouTube like what, less than a month ago, and he's already like 6,000 subscribers.
Because your portfolio length and what's public, you're on Blossom, you're on all the different Discords, and you already have a presence. You'll see the same sort of trajectory that he saw very fast.
Really?
So just make sure. Yeah.
Would I be more relatable to the younger side because he is like
because you're younger
almost
and
60.
he's the older. That's it. But that's for everybody, right? You're always gonna be more relatable with whatever your demo is. Right. So like, I'm more middle-aged guys with families. Like, that's who like watches my channel. Like, people just trying to figure it out, but a little bit younger too, because I'm in 39. So like a little bit younger hits me, and all older. I'm someone who could think about retirement. I'm also someone who also thinks about day-to-day family bills. And I wasn't 25 that long ago, so I still understand a bit of that.
Yeah,
so
you're
like,
good.
I'm a little bit in the middle, but whatever your demo is, you're always going to appeal to more. And you got to speak to that. So make sure you speak to it. Don't like be like, hey, this is what I am. But also, if you are retired, this is how it would probably work for you, but just frame it properly, right? Perry goes like, hey, I'm retired, and that's why people relate to him. So there's a lot of people like that. But you're going to migrate over all your Blossom viewers. You're going to migrate over your Discord people. So you'll immediately, like most YouTube channels will probably struggle to even get a view on their first video regardless.
Right.
But because you have people that's coming in from other sources, YouTube will be like, oh, why are all these people coming in from Blossom and Discord? It'll think it's more popular video. It'll push it more. You'll get more viewership. And if you have a portfolio breakdown as your first video, it'll tell YouTube exactly what kind of channel you are. Like, oh, this guy talks about cover call ETFs, these specific ones. It knows how to index you in the algorithm, and it'll be able to find the right audience for you immediately. There's no confusion about what you do. It's like, I know about cover call investing. This is what I do. It'll find your audience, especially with all that Blossom data coming in. Like,
Right.
oh, that user from Blossom, they have their watch history. They go, oh, he watches all cover call content. Now he's watching your channel. It'll be, you will know this. I'm not sure how much YouTube's done in the past, but because I deal with this
First
all
time.
day, you're coming in, like you're optimizing the algorithm so fast without even trying that you're going to
Okay.
see results 10 times faster, same way Perry did, than a normal person who just started. Right? So you can expect that, but just so long as you start with your first like main video with a portfolio breakdown, nothing else.
Okay.
Don't do like here's what an ETF is, none of that bullshit. Just be like, no, I make this much money a month. Here's what I hold. Let's break down each holding. You're golden.
Okay.
That is like money in the bank for YouTube. That's like, there you go. You got yourself a banger. And then blast it on socials. Everyone who follows you will want to see your breakdown. As simple as that. And then you can spend the next bunch of videos breaking down specific positions. All right, here's why I bought this specific one. Like you just bought WPay. That's the video. Here's why I bought it. Here's dissecting it. That's all content. But start the first one with here's who I am. Here's my portfolio. Boom. Here you go.
Should my channel be specifically on finances? Because I kind of want to do a little bit of everything, but would that be too...
Start there, because you got to give the algorithm something to work with, and then slowly bring in other topics, feed it in. But you need to give the algorithm some direction, or else it doesn't know how to get the right audience for you.
Right.
So give it that, and then let's say 80% of your content is one thing, and the other 20% is the other stuff you want to talk about.
Okay.
So that's the quickest way to grow, right? So use that kind of split. So like on my channel, it's all finance, but then 10% is every once in a while I'll do a health video because I want people to stay healthy.
Right.
Right. Yeah. And so, but even within finance, there's niches. I do growth investing, value investing, and cover call investing. That's already a lot for the algorithms to work with. Because those three types of investors don't talk to each other. Right? So you actually split your audience, and it makes it harder for the algorithm. So some videos won't do well, even though it's a good video, because cover call investors don't care about it. Although my value investing videos, my growth investors don't care about, because they just want ETFs. They don't want to pick an individual stock.
Yeah.
Like I actually have conflicting audiences within my channel, but I don't care. I'm just pumping out content. So it's like, if it gets big enough, they'll all just care eventually. But for you, it's like pick a direction, pick a dialed in niche, grow that, and slowly expand outside of it. And people will follow along with you when you expand. And that's kind of what's happened with me. People are going like, okay, we get what this guy's all about. He wants to talk about value investing. We'll let him. We'll watch it this time. And that's kind of what's happening.
Gotcha.
So yeah, that's it. But you'll be fine. You'll do really well.
And then in terms of, because I kind of want to do a bit more casual settings. I kind of don't want to do what Perry did, where he's like he's like sitting at the computer and actually going down one by one. I kind of want to do like a casual sit down, me at a desk, kind of like what I'm doing right now. And then I don't know if I want to have like a wireless mic or like a desktop mic, like those kind of like fine tuning nuances. Like, do you have any?
You just need good audio. Who gives a shit what you have? Just have a good audio. You just need really good audio. Audio is more important than video. You just need clean audio. So whatever mic picks up your voice the best, right? So just get like a Rode mic, a wireless mic, whatever works, and just use that. I wouldn't even worry about that. No one even cares in the end. I'm filming in my office. This is my actual office. So I just film it because it's the easiest. I have my computer and everything set up here. I'm just working, turn the camera, talk to you, and I get back to. I'll go right back to work after this. Right?
Okay.
So I'm more for convenience. This is just like the most convenient setup. Perry, just do whatever's natural to you. Just be authentic to yourself. Don't even try to put on any sort of act. Don't try to do anything. Be like, how do you operate? Only work how you operate.
Okay.
That's it. I operate like this, so this is what I look like. That's it. I wear this shit every day. I look like this every day. I'm sitting in this exact spot every day.
That's the authenticity.
This is my life. You're literally just seeing, this is me in this moment in my life. There's no difference. I don't get ready and then come talk. It's like, I'm already like this. I'm just sitting down, turning on the camera. My computers are already turned on. Everything's already working. I'm just sitting here. All I'm doing is turning on a camera. You should have something similar, right? So just do that. And then the rest will take care of itself. Focus on quality content, good information. Don't worry about the nuances. No one really cares in the end at all. So
once you release this podcast, can I put it on my YouTube? Is that okay? Would that work?
I don't know how that works. You can post it on your YouTube. You can be like, hey, or check out this and link it through to your YouTube. I don't know if there's like a pinning model, but a lot of people make a post. Like a lot of people who I do podcasts with will go on their YouTube channel, make a post, being like, hey, check out my thing, and then they'll
I'll probably post it like on the homepage.
That's how most people do it. Okay. And then they post it on all their socials and stuff. But yeah. Okay, I'm gonna wrap this up because it's been almost 4 hours. I really appreciate you talking to me, JJ. Check out his YouTube channel, which will probably be launched by the time you guys see this.
Yes.
Join us on the Gary Gill Wealth Academy because he's there all the time too, answering questions.
Follow
Alongside
on
me.
Blossom. That's the most important part too.
And on Blossom, and you can just type in, what's your handle at Blossom?
At JJ Pandy, so JJPANDIE, all lowercase.
Awesome. Alrighty. Well, I'll probably talk to you right after this. Alrighty. Bye-bye.